Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Diane King Hall. And Brad Smith is on assignment. Here are three things you need to know this morning. Investors brace for a second day of congressional testimony from Fed Chair Jay Powell. His comments that rate rises have further to go weighed on equities yesterday, especially the growth stock heavy Nasdaq. His position fueling bets that the wheels might be coming off a seemingly unstoppable AI-driven market rally. A different tone, though, from the Atlanta Fed's Raphael Bostic. In an exclusive interview with Yahoo Finance, Bostic said his baseline is to stay at this level for the rest of the year. Other global central banks are fully in tightening mode. The Bank of England and Norges Bank both hiked interest rates by 0.5%. On the earnings front, we got a read on the consumer with Darden Restaurants beating the street with fourth quarter earnings. The stock is falling, though, in early trading. The restaurant operator saw an unexpected decline in its fine dining segment that includes the likes of Capital Grille and Eddie V's. Same-store sales there all down almost 2%. Olive Garden's performance also weighed on sentiment. The Italian restaurant chain, which accounts for about 45% of Darden's sales, had a weaker than expected performance in the quarter. And don't call it a comeback. Bitcoin breaches $30,000 as the largest digital currency jumps 10% in 24 hours. It comes as a number of traditional finance players like BlackRock and Fidelity push further into the space. Not hit since April, $30,000 has been a difficult level to reclaim. Could be tested today on Jay Powell's remarks.
And Federal Reserve Chair Jerome Powell is back on the Hill today at 10 a.m. Eastern, but the market is still feeling the effect of yesterday's testimony in front of the House Financial Services Committee. His hawkish tone reversing the recent AI-driven rally. Let's take a listen to some of what he had to say.
Given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. A while ago, there were 2 jobs for every unemployed person. Now we're down to 1.7, I believe, or 1.6, and that still speaks to a historically tight labor market. We're not there yet. We still have a significant excess of demand over supply.
So will the market downdraft continue, and are investors pricing in more tightening? Joining us now on this is Anastasia Amorosa, iCapital Chief Investment Strategist. So, Anastasia, I got to ask, is the market pricing what their expectations for the Fed are correct?
I think they are, absolutely. I mean, the fact that we priced out the rate cuts from 2023, that was a significant and important repricing that needed to be done. And now we're pricing at about a 70% probability of a July rate hike. And again, that's probably about right, although that can whipsaw, quite a bit because we're still a month away from the next Fed meeting. So I do think the markets are hearing the Fed. They're hearing Fed Chair Powell saying that the job is getting done. It's progressing, but it's certainly not done yet. And I will say, Diane, I think one of the remarkable things about this market has been that tech, not this week, but prior to this, has been able to rally even while we had this repricing in the 2-year Treasury yield. So that, to me, sort of speaks to the market that is driven more than just by Fed expectations at this point.
Well, and sort of to that point, Anastasia, are stocks rallying despite the fact that the Fed is going to raise rates a couple more times, or are stocks rallying because whether or not the Fed is done or it's twice more, they're almost done, right?
Right. Yeah. I mean, close to done or done. I mean, I think, it's semantics at this point. And look, after the Fed has delivered over 500 basis points of rate increases in the short amount of time, what's another 25 basis points or another 25 basis points on top of that, especially if the pace of that gets spaced out over, let's say, months, if not quarters. So I think that's why the markets have been able to kind of look through this and shake it off. And look, I do think that the Fed has to stay at 5.25. Maybe they go to 5.5, 5.75, and they just have to stay there. So I think that's what the markets have also gotten comfortable with, is we don't need to see rate cuts. We just need to see a stable economy and the Fed that is keeping rates where they are today, or maybe a little bit higher, and let the inflation do its thing on its way to coming down.
So to your point about letting inflation do its thing, I mean, Federal Reserve Chair Jerome Powell stopping short of actually calling the last move a pause. Would you say I know what expectations are for July, but do you think that the Fed needs to go anywhere past another 50 basis points?
I don't think so. I don't think so. First of all, Fed Chair Powell said it yesterday and also at the meeting last week. And he said that the conditions that needed to be in place to let inflation start to decline, those conditions are finally here. And what it's referring to is you need to have GDP growth that is below potential. Potential is right around 1.5%. We are pacing 1.8% this quarter, but likely we're not going to get there for the full quarter. So I think we do have that first condition, below potential GDP growth. We have the labor market that is clearly rebalancing. He mentioned those job openings and the ratio of job openings to the number of unemployed people. It has also declined. So that's a healthy development. And then when you look at some of the biggest culprits that drove inflation higher, it was fuel prices, it was food prices, it was supply chain bottlenecks. And all of those things have all that but resolved. And I guess the last part to put in here into this pretty complex inflation puzzle, you've got services inflation that's a function of wages that has been coming down. And you've got housing inflation that Chair Powell also expects to start coming down. So I think a lot of those conditions are in place. And that's why if they just stay pat and let this trajectory play out, I think we will eventually see threes, if not twos, on inflation.
Right, although it doesn't seem like they're likely to stay pat right now. But, things could change before we get to the next meeting at the end of July. Anastasia, what does all of this imply for where the markets are going to continue to go? Yes, we've had a little bit of a pause, right, from the rally. Do you think that's going to resume, and how far can that take us?
Yeah, I think this market has done a lot in a short period of time. You've got the S&P that, prior to the recent pullback, that rallied almost 8%, in 6 weeks or so. You've got the Nasdaq 100 that's up 37% on the year. That is a massive move. And I think we were absolutely ripe for some sort of a pullback, some sort of a consolidation, because what's really driven this kind of last leg of the rally is a lot of people realizing they're not long enough. They're not long enough tech. They're not long enough equities. And they were jumping in, whether that's hedge fund investors, whether that's retail investors. And I think a lot of this sort of, initial pent up demand for equities has likely been satisfied. And, if you get, more hawkish messages from the Fed, if we have to reprice the Fed trajectory higher, or if we got some bumps along the way as we head into the second quarter earnings season, I think you could have catalysts that make this market pause and consolidate. So I think it's very normal at this point to give some of the rally back. Now, having said that, Julie, we're going to talk about the consumer. We talk about the U.S. economy. It is surprising to the upside. And against that backdrop where the Fed is close to done or done, and the economy is actually outperforming expectations, that bodes well for earnings. And that in turn bodes well for stocks. So I guess the bottom line is, if we get a pullback, I think it's very much a viable one.
Anastasia, I want to get your thoughts on this. Yesterday, we heard some more Fed speak. We had an interview with our Jennifer Schomburger with Atlanta Fed President Raphael Bostic. I want you to take a listen to that because there is a differing viewpoint in terms of the path of Fed rates. Let's take a listen.
I do feel like we're in a position now where some patience can do us well. And look, I really want to try to do all I can to make sure that we avoid a significant economic downturn.
Now, Bostic, not a voting member, but what do you make of what he said? And do you think it could potentially influence the path of rates?
I mean, I think we are very much splitting hairs a little bit at this point. And, there's a very balanced view that I think a lot of the FOMC participants hold. I mean, of course, from the credibility standpoint, it does seem like the Fed needs to do more because core PC inflation is still 4.7% and it's not quite 2%. But at the same time, I think what we've heard from Bostic also holds makes a lot of sense because we've done so much. And then the other slow motion thing that's playing out is credit conditions. They have tightened significantly, and credit availability to the economy is likely to drop in the coming quarters. So that's happening in the background. And so knowing that, let that part of the cycle do its job now in terms of slowing down the economy. and pause on the rate hikes. That argument also does make a lot of sense. But I think, when you net out those two things, the credibility versus let's just let the credit contraction cycle play out. When you net out those two things, I think that's why you get, maybe another 25 basis points, maybe another 50, and not the sequential rate hikes that we've been getting.
Anastasia, stay with us because, as promised, we're going to get to the consumer. Of course, a slate of earnings reports in recent weeks have shown that consumers are tightening their belts, at least in the margin, when it comes to spending by making more selective purchases. The question now is whether that discretion is spread to services from stuff. This morning, we did get a clue. Darden Restaurants reported its fourth quarter earnings, and the stock has been falling in early trading as the restaurant operator saw an unexpected decline in its fine dining segment. It also reported mixed comparable sales results, including a very slight miss for Olive Garden, a beat for Longhorn Steakhouses. And the fine dining piece really interesting here. It owns Seasons 52. It owns Capital Grille. It just closed on the acquisition of Ruth's Chris Steakhouse, which is not included in these results because it just closed on June 15th. But nonetheless, is this a sign perhaps that we are seeing now on the services side a little bit of a pullback? Anastasia Amoroso is still with us, iCapital Chief Strategist. And Anastasia, I don't know how, I know you're a macro, not a micro type of person, but as we read the tea leaves from earnings, are you taking away here that indeed we are seeing consumers start to change their spending patterns, not only on the goods side, but on the services side?
I think that's a bit of a premature conclusion. Obviously, we did get the Darden report that maybe suggests there's some weakness in the fine dining segment. But when I look, Julie, to a point, to the big macro picture, what I see is the consumer that has a job and is getting paid more for that job. 3.5% unemployment rate, 4.4% year-over-year wage growth. And by the way, when you take inflation into account, that means that actually in real terms, wages ever so slightly are going up. So that's discretionary spending power that's still very much for the consumer. Then I add to that $1.5 trillion of excess savings that the consumers still have relative to pre-pandemic levels. And then I look at the household debt burdens, and household debt was 24% of net worth, and today it's about 12%. 24% was, at the peak of the financial crisis. So the point is, the balance sheets, the cash flows of the consumers are really, really in good shape, and that's why I don't see a big change of trend there. Now, speaking of trends, Julie, when we look at the retail sales reports, when we look at the real-time, real-life credit card spending data, we see a very clear trend, is that consumers are prioritizing their spending. They are starting to spend less on gasoline, thankfully, because gasoline prices are coming down. They're spending a lot less on durable goods because they don't need as much furniture anymore, but they're continuing to prioritize month over month spending on food and drinking places. And again, we see that in the real-time data for June as well. So I don't see a big change of trend here, but perhaps, some paring back, and maybe, the declines in the fine dining segment for Darden, could be due to some of the corporates that are maybe trying to rein in the expenses. But I think overall, this segment will continue to remain strong.
So less Capital Grille, but certainly Olive Garden still in play here. But let's talk about the consumer as we get towards fall. Obviously, you point to consumers holding about $1.5 trillion in excess savings. That could certainly take a hit. Just continue to kind of play out the naysayer aspect of this in the fall once those student loan payments reactivate. What is your expectation there, Anastasia?
Yeah, it is going to be a hit to the discretionary income of some consumers. But when we look at the numbers for student loans, once the repayments do kick in, it's something like 1.6 to 2% of discretionary income. So it's not as big of an amount as one might imagine. And also, when you think about, individuals who may be making those student loan repayments, there might be some of the higher income individuals. So that might not be even that hit might be even smaller than that. So I do agree with you, Diane, that it is still a drag on consumption that will kick in. But I would say it's a very incremental one versus that would derail the whole consumer story.
What's interesting is how resilient we have seen the consumer and also just corporate America broadly, right? Our Miles Hudlin in the morning brief today writing about that and how earnings tend to beat estimates, right? Let's be honest. But this season in particular, this past season, we saw earnings beat estimates by a pretty big margin. Are we going to be able to continue to see that cadence fueled in part by the consumer? But of course, corporate clients are going to need to participate in that too.
Yeah, Julia, I'm actually fairly optimistic on the earnings picture. And I know that the estimates for especially the third quarter and the fourth quarter are definitely more optimistic than the first quarters of this year. But the reason I'm optimistic is because when you think about what's driving those earnings, it's how's the economy performing and what can you do in terms of your bottom line and cost savings. And speaking of the economy, it outperformed in the first quarter, and it's still on track to outperform in the second quarter relative to consensus that was expecting 0% GDP growth. And instead, we're coming in on track to 1.8%. So as a result, what was a trend of earnings estimates downgrades is actually a trend of upgrades to earnings right now. So I think that bodes really well. And then the second part of it is cost savings. Companies did not just sit idly, worried about the economic outlook. They cut costs where it made sense. They went into this margin preservation mode. And I think that too should support the earnings story.
All right, Anastasia, hold on, because there's another hot topic that we got to get to, and that is the crypto rally. It's escalating this morning with Bitcoin climbing above that $30,000 mark. It's not hit since April, and it's been a difficult level to reclaim. Could be tested today, perhaps on Jay Powell's remarks. But Bitcoin has climbed by about 20% since June 15th. That's when BlackRock said it was filing for SEC approval of a spot Bitcoin ETF. Yahoo Finance's David Hollerith joins us in studio with the latest. It's been a really interesting move here. And that was a surprise filing from BlackRock. We've gotten some other filings too. Is that what's going on here? Is that there's this final move that a lot of people have been waiting for?
Yeah, I mean, it's always tough to pin it on to pin a rally on something, and it does seem like it started a week ago,
right?
With the BlackRock filing. And since then, obviously, we've seen what's become, the Bitcoin ETF horse race, which is like all these different asset managers have since filed. But we've also seen other moves, like Deutsche Bank has applied for a digital asset license in Germany. And then EDX Markets, which is backed by Fidelity, Charles Schwab, and Citadel Securities, is launched. And they're a new crypto exchange, and they look to be completely traditional finance backed. So there's a lot going on here, and we're kind of getting a sense that it's maybe a winds of change for the sector. And obviously, earlier this month, we saw these lawsuits against Binance and Coinbase. So it's a very interesting time, and I think a little bit complex too.
Is the crypto winter over, if you will, or is it still, kind of just taking a little bit of a backseat while you get some credibility from this ETF?
A false spring.
Yes, there we go. I like that analogy.
Yeah, I mean, I don't know. I think I saw one interesting interpretation, which is just that, cryptocurrency, Bitcoin has been doing great this year, but in some ways, the AI S&P rally that we saw last month hadn't really caught up with cryptocurrency. So in some ways, this might be interpretation, with these announcements that it's just sort of a shift and, cryptocurrencies is catching a bid now. But I think it's pretty early to declare any sort of end of the winter. But if you talk to a technical analyst, they'll look at the charts and say that Bitcoin is out of its bear market. We'll see if it stays there.
I saw a comment yesterday that you're not in town very often, and I saw a comment, I think it was Joe Weisenthal yesterday, who said there is now a Bitcoin mined heated spa in Brooklyn. Bitcoin mining generates the electricity that makes the heat for the spa. So you'll have to go visit.
I feel like we need a field trip for that.
Exactly.
See what's going on.
Yeah, a little field reporting for sure.
Indeed.
Good to see you, Dave.
Yeah, great. Yeah, great to be here, guys.
Thank you for joining us. We appreciate your insight. Great reporting as usual. All right, let's bring back in Anastasia Omarosa, iCapital Chief Investment Strategist, for more on the current state of the crypto market. So Anastasia, I got to point this question to you. So it just seems like it's risk on in general. So is that what's happening here from your view in terms of crypto?
I think that's absolutely one of the things that is happening. When you look at Bitcoin, it has been more correlated to the Nasdaq recently than it has been to other things. So the fact that the Fed is seemingly pausing and risk assets are rebounding, that's also propping up the price of Bitcoin as well. I think that's one thing. The second thing is, of course, the Fed expectations, and the reason why it's really difficult for Bitcoin to do anything throughout 2022 but go down was because the Fed was aggressively hiking rates. You were getting paid on your cash, and inflation was elevated. And now if the Fed does eventually pivot to staying pat or maybe cutting rates, then that advantage of holding cash, once again starts to potentially go away as well. So that's longer term, but again, incrementally supportive to Bitcoin. But I would say there's one more factor that is driving the price move here, and that is Bitcoin and the crypto ecosystem has been through a hugely enormous important test, whether they can actually withstand the test of time and sort of the test of some of the scandals that we saw in the crypto space last year. And the fact that institutional investors are still stepping into the space and still stepping into Bitcoin, that really tells you that this is an asset class that is most likely here to stay. And amidst, I think at some point there's 6,000 different crypto protocols out there. Amidst those 6,000, the ones that are not viable have fallen away, but the ones that are here to stay, like Bitcoin, are gaining strength.
And Anastasia, do you all have a recommended allocation to Bitcoin at this point? How has your thinking sort of changed on that over time?
Yeah, we've thought about this a few years ago, and I've always thought about Bitcoin or maybe other areas of cryptocurrencies as a tech asset. The reason why somebody would invest in Bitcoin, could be potentially because they don't trust the Fed or the U.S. government to do a good job managing the currency, or they want to have another means of payment transfers. And also it's a more efficient, potentially more efficient way to do cross-border payments. So there's a technological aspect to Bitcoin, but there's also a volatility that is associated with that is much more in line with a high-flying, high-beta tech stock than anything else. So when thinking about sizing that allocation, I would think of it as sort of one of the tech holdings in a diversified 30-plus stock portfolio. And so when you think about it that way, an allocation somewhere between 1% to 3% of the overall portfolio, that's what we would guide as a starting point. Now, obviously, as the asset class gets more established, gets more regulated, and perhaps the volatility subsides, there's scope to increase that allocation, but I would start small, 1% to 3%.
Speaking of the regulatory climate, Anastasia, so when you look at, say, Binance or Coinbase and the issues going on there are different allegations for both of them, but you're certainly seeing that crypto crackdown that, the SEC talked about. Do you, one, think it's warranted, or do you think they're kind of two very different types of companies that we're dealing with here, where we're talking about Binance or Coinbase?
I mean, I really think the regulators are trying to figure out exactly how they want to regulate the space, and we're sort of seeing that play out. But the fact that, there is so much more regulatory attention and trying to draw the distinctions between the companies, I think that's a long-term positive for the space. The other thing, too, when you go outside of the United States and when you go to Asia and other places, there's regulators that are also trying to legitimize and regulate parts of the crypto ecosystem. So to me, that's a really important part. So I don't want to comment on specific, stocks, public or private, but the fact that regulators are paying attention, I think, is a very positive thing for the system.
Anastasia, good to see you. Thanks so much for joining us this morning. Anastasia Amoroso is iCapital Chief Investment Strategist. See you soon.
Great to see you.
Coming up, Tesla investors are unplugging from the EV maker this morning. It's down about 3%. We'll tell you about the analyst call that's causing that move next. Well, another day, another downgrade. We're talking about Tesla. The shares are dipping today after Morgan Stanley's Adam Jonas downgraded the stock to the equivalent of a hold from buy. He did increase the price target to $250 from $200 a share. He says Tesla is still a must-own EV stock, but high expectations in AI, he said, bring the stock to a fair value. The stock taking a hit of 3.3%. It was downgraded by Barclays yesterday on similar valuation reasons. Just got the note here, and it's quite interesting here because he basically says that while he's still bullish on the company, he doesn't think it is an AI play. And he also says there is a little bit of confusion or a little bit of false combination of AI and autonomous driving. He says they remain two very different technological disciplines. While the market may want to dream on the AI theme, we'd prepare to wake up to the sound of a blaring car horn.
I know, and you know, I'm seeing Tesla as an AI beneficiary and an auto company, so it's a AI adjacent, if you will. It seems like that's the viewpoint from Adam over here. And, you know, also interesting to note about his price target and where it stands today. I mean, look, it's, I mean, in the pre-market, sure, it's down 3% as we noted, but the price target, seeing it as 250. So, you know,
which is still a little bit below where it is right now.
It's a little bit below where it is right now. But there's a bull case price target as well, which is much higher.
Right,
So,
and a bear case one that's much lower.
Yes.
So, I mean, you know, it basically, again, what he's saying here is that it is based on hope. He calls it the AI-based re-rating of the stock is a non-disprovable bull case. In other words, you can't disprove it because it's all just sort of speculation and hope at this point. So, as is typical for Tesla, there is this element, this overlay of what people want to imagine it's capable of. And Tesla has proven time and time again that it is capable of some of those things. That's why I guess it's also not disprovable, because it does have a track record, but we still don't know. We can't predict the future with enough certainty, he seems to be saying, to price in this AI future.
Right. And let's put a pin in this. We got to get to the broader market action first. We just had the opening bell ringing on Wall Street. I want to do a quick check of the broad market action. We've seen kind of a downdraft happen this week as Fed Chair Jerome Powell talks more about the path of rates and faces off with Congress. Investors cooling their heels a bit, looking like stocks are range bound in the early action. Dow, S&P 500, all under a little bit of pressure. Under a little bit of pressure at the moment, but you know, pretty micro movements, 0.25% down for the S&Ps, Nasdaq down just short of 0.4%, S&P Dow rather off just by a little more than 0.1%. Let's get right over to Julie at the Wi-Fi Interactive. Julie, what are we looking at?
Well, what we've been looking at here is not just this decline today, but really a decline that's been happening for several days now. I'll stretch it out to the 1 month so you can kind of see this bit of a downturn, right? This is the Dow that we're looking at in particular. If you look at the S&P 500, you see a similar, more muted pattern, and then the Nasdaq as well. There you have seen, obviously the climb has been more, but also the sell-off over the past few days has also been a bit more acute. This is the group that is the most interest rate sensitive, for example, or it has been, right, during this current hiking cycle. So once again today we're going to hear from Fed Chair Jay Powell. Could we continue to see more pain for the tech trade? That remains to be seen. He begins speaking at 10 a.m. We'll talk about that in just a bit. But for now, let's take a look at what's going on the sector level and elsewhere as well. So here we've got energy stocks that are down once again, material stocks as well, and real estate. And then on the flip side, we've got consumer staples, healthcare, and utilities that are helping stem some of the declines. I mentioned what's going on with the tech trade. So let's take a look at the Nasdaq 100 here. Not only is Tesla down, as we just talked about on that downgrade, to what's effectively a neutral from Adam Jonas over at Morgan Stanley. But he mentions NVIDIA sort of in passing in his note as being the more direct AI beneficiary than something like a Tesla. NVIDIA shares are also down in today's session, and they've participated in this sort of pullback or roller coaster that we've seen over the past few days. Actually, it's been kind of up and down in the case of NVIDIA. Meta down as well, Alphabet down, but then you got Apple, Amazon, and Microsoft that are on the rise. So you've got this split situation. We've We've been talking a lot about what's going on in the crypto markets here. We've got Bitcoin that is trading higher by 4%, holding above that 30,000 level that we have discussed. That is quite key. The other cryptocurrencies also largely seeing a gain. And then if we look at some of the crypto stocks here, interesting to see the movement in some of these, a pretty split market. When you look at these, for example, I'm just looking for Coinbase up on my screen. Here it is. It's up just about 1.5% on the day. This is the 3-day chart where it's been climbing in tandem with Bitcoin.
All right, we've got crypto action in play. Meantime, Boeing supplier Spirit AeroSystems is halting work at its Wichita, Kansas plant as a workers' union votes to strike. You're looking at shares of both companies under pressure. Spirit AeroSystems down 10.5%, Boeing down 3%. This stock's falling as the Wichita site is responsible for production of part of Boeing's best-selling 737 MAX narrow-body jet, as well as parts of its other aircraft. This is a labor story once again. We've seen this, we have that potential headwind for UPS with those voting to authorize a strike. So again, labor force gaining more power. It's a difficult time, though, when you think about production and demand for jets. I mean, Boeing trying to meet demand of, what is it? I forget how many jets a year right now, 2,000 jets a year. So this is definitely why we're seeing a hit to shares of both companies.
Yeah, I saw that the commercial chief was cited by Bloomberg as saying in an interview that they're trying to ramp that 737 MAX production to a rate of 42 on a monthly basis before the end of the year, because they are seeing that demand that you're talking about. So this definitely is a problem for that, because Spirit AeroSystems makes most of the fuselage of that plane. So if they're not making it, that's going to make it very difficult for Boeing to make that target. And it's especially a difficult time, not just from a macro basis of the demand, but for Boeing specifically, because it is trying to come back and has seen a number of setbacks to that. Little side note here, Spirit AeroSystems used to be part of Boeing until 2005 when they spun it out. And so now the former unit is seeing this union difficulty.
Yeah, indeed, dealing with its own woes, separate and apart, but also back together again. Still family woes.
Exactly. And then there's one more mover we got to talk about. That's Overstock.com. Those shares are surging. The retailer winning an auction for the defunct Bed Bath & Beyond's intellectual property and digital assets. Court records showing that the e-commerce company expected to pay $21.5 million for those assets. The sale's not going to include bye-bye baby assets or keeping the stores open. This just has to do, again, for the IP, with the IP and the digital assets. This is something that was a discussion in the wake of Bed Bath & Beyond filing for bankruptcy. Who is going to pick up the slack? And we actually spoke to Jonathan Johnson, the CEO, and asked him, will Overstock benefit? And he said, yes, we should benefit to some degree from some of that demand. But now also, getting that branding.
Yes, they are. They're getting that. They're not, as we've talked about, the not picking up the bye-bye baby piece of it. So that, not part of this. And it's interesting to see this, kind of come together in the internet age, internet space, Overstock being the beneficiary of them heading into bankruptcy. Who knows what happens to those 20% off coupons, if those will head over to Overstock? I doubt it.
That's a good question. I mean, Overstock is already known as being relatively low cost, so that they have a range of different items. And it's also interesting in this environment, like what is Overstock? How are they doing more broadly, given that we've seen a pullback in furniture buying, for example?
I do like Overstock, though. I'm a fan.
Yeah.
I've bought some stuff from there. All right, switching gears. The beauty industry is huge and is expected to get even larger, especially in China. Companies like Sephora are investing even more in the world's second largest economy. The beauty retailer just earlier this month opened its first store of the future in Shanghai. Now, McKinsey says it expects the Chinese beauty market to hit $96 billion by 2027. So which brands should investors be watching as this space grows? Joining us now on this is Linda Bolton-Weiser, D.A. Davidson and Company Managing Director and Senior Analyst of Health and Beauty. So what are the beauty brands that you think are the winners?
Hi, thanks for having me. Estee Lauder is a company that has significant exposure to China. They have more than 40% of their revenue is China-based or related to China travel retail. But in terms of stock picking and performance, our top pick is ELF Beauty. ELF actually does not sell into the Chinese market yet. They're mostly a domestic company, but they're rapidly rising in the mass beauty color cosmetics market. So they've overtaken Revlon and CoverGirl to become number 3 in the US mass beauty market. So they're experiencing very rapid growth, most recently way above 30% growth of sales for ELF.
Linda, how unusual is that to see that kind of movement within the massive beauty industry that has a lot of sort of entrenched players?
It's actually really unusual to see the rapid rise of a brand the way ELF has risen in recent years. So the entrenched top player in mass is L'Oreal with their L'Oreal and Maybelline global brands. And for a long time, you know, you had Revlon up there, CoverGirl up there, and now ELF has surpassed. So it's highly unusual, but they're gunning for number 1. They want to be number 1 in the U.S. mass color cosmetics market.
And Linda, I got to bring in kind of the skincare part of our conversation when we talk about beauty. That's been a growing segment of the industry. So who would you say are the winners in that space when we're talking about penetration here in the U.S. and in China?
Yeah, absolutely. Skincare is a bigger percentage of the market in Asia and in China. Asian women really care about their skincare routines. And so there again, Estee Lauder has very good positioning with their Estee Lauder brand, with their Crème de la Mer brand. And Coty is increasingly working at penetrating the Chinese market, and they've recently launched their Lancaster brand, which is based in Monaco, and that is going to be an anti-aging brand for the Asian market. And ELF in the mass beauty market also has skincare, and so that's a much smaller piece of their business, but that's growing rapidly for them.
Linda, talk to us about the role that social media is, and especially TikTok, is playing in the beauty industry now, right? Because I know that ELF in particular has kind of, I don't know about conquered, but has a big presence, right, on those social media channels.
Sure. Really, social media is incredibly important in driving the relevance of beauty brands. But the brands are very nimble, so they use many different platforms, and they are very strategic in how they move their presence from one platform to another. And so I wouldn't say that any company has any, outsized risk, in terms of their exposure to TikTok. But certainly TikTok, Instagram, these are all platforms that really all of the beauty brands utilize.
So Linda, so they all utilize them. Do you think going forward they need to maintain that presence there, especially if you start to see some of the, let's say if we do head into any economic pullback later in this year, do you expect us to continue to see that focus on social media and the brands having a big presence there?
Yes, absolutely. I mean, the key to long-term success in any kind of beauty branding business is to continue to invest in your brand, even in downturns. And Estee Lauder is really well known for that. They continue to invest heavily. ELF Beauty, for example, has been increasing their marketing spend, and it's risen to, 18% of revenue, even higher. And I expect even in a downturn that brands will continue to invest heavily behind their brands.
Well, and I want to pick up on that downturn a little bit. One of the younger producers who's a TikTok native, unlike myself, pointed out that not only are these brands advertising, but ELF in particular makes sort of less expensive knockoffs, for lack of a better word, of some of the more expensive brands. So is it poised then to benefit in particular as we start to see the economy weaken?
Yes, certainly. As a mass brand, ELF is much more affordable and the products are high quality. And so you might pay $10 for an ELF product versus $30 or $40 for a similar prestige product. So yes, there could be some trading down. However, Coty, which is involved in both mass and prestige cosmetics, has said that they have seen no specific trading down behavior trends really in consumer beauty at this point. So right now, really, prestige and mass are both growing very nicely in terms of the beauty sector holding up fairly well.
Interesting stuff. Linda, thank you. Good to see you. Linda Bolton-Weiser is D.A. Davidson & Company Managing Director and Senior Analyst of Health and Beauty. Thank you.
Thank you.
Coming up, we're going to head overseas to Cannes, where Brian Sozzi and Brad Smith sat down with an executive from Kraft Heinz. We'll bring you that interview next.
I'm Brian Sozzi here with Brad Smith at the Cannes Lions Festival of Creativity. And joining us now is Kraft Heinz Chief Growth Officer of North America, Diana Frost. Diana, good to see you.
Great to see you guys. Thanks so much for having me.
I was thinking back with Brad a little while ago. We have not talked to a lot of awards winners here. We talked to Kevin Hart. He won Entertainer of the Year.
Absolutely.
You and your team are an award winner at this event, which I think sets it up for the bigger things that are happening at the company. What did you win for? And what does it say about where Kraft Heinz is at this moment?
Yeah, I just couldn't be prouder of the team. And we've talked a lot about our transformation, and you've been such a great proponent of our transformation and what we're doing to lead the future of food. And future of food comes with connecting with consumers and changing behavior. And that comes with how we're investing in our brands and how we're unleashing creativity throughout all of Kraft Heinz. Last year, we came here with 28 shortlists. We're sitting here today with 83. And a number of wins under our belt from multiple different categories. And so the piece that I see is that's the beginning of the flywheel, to lead the future of food, connect with consumers, and fuel the investment.
What are you exactly winning for? What things are sticking out?
So a couple of things. I would say a lot of the majority of our wins have come from our global brand Heinz. One of the wins in particular was in the print and outdoor category on Heinz ketchup fraud. So one of the things we learned from consumers, which was quite an insight, actually not even consumers, we saw on social media that in restaurants, people were actually filling up Heinz ketchup bottles with the cheaper version.
That ain't right.
That's not right at all. Yeah. So I think one of the things that we saw with that insight and where the campaign came from was even when it's not Heinz, it has to be Heinz. And so that fuels and actually ties into the global platform of Heinz of it has to be Heinz.
I feel bamboozled, quite personally.
Absolutely. And it was happening
a lot of money
everywhere.
for those experiences.
Yes.
So what we need to know as well is what that sets up for your end of year spend as you look through the marketing budgets broadly that have been cut for many corporations at this point in time. What do winning awards like this do for you securitizing even more of that spend from the higher ups at the business?
Yeah, I think it does a number of things, and it actually starts with the culture and the people believing in the transformation. Yeah. And we've been talking about that. So I think that it starts there. I think the second piece is that then fuels creativity, which then delivers on business results, which then gives you and fuels more investment. So as you're seeing a number of companies, as you said, cut investment, we're continuing to invest, and we will invest and increase year over year versus last year, almost in the double-digit range.
Where do you prioritize that spend?
To be honest, you pour fuel on the fire. Yeah. And so as we live in a dynamic environment with consumers, we're learning real time which are the channels that are working best on which brands. As you both know, we live and work in 55 categories, 35 brands. There are a number of brands that we will continue to pour fuel on that fire. For year-end, Heinz being one of them with the new global campaign we just launched.
Is mac and cheese still a growth business?
Absolutely.
How so?
If you look at quick with quality, one of the biggest consumer trends that we see now and is going to continue to actually grow over the course of the next 5 years is consumers want the quality with convenience. Mac and cheese plays so well in that. The other place that we saw a resurgence with consumers over the course of COVID is this idea of holistic wellness, which includes comfort food and food for the soul. Mm-hmm. So not only food for the body, but food for the soul. So you actually put those two trends together. We see a great opportunity in mac and cheese now and also in the future.
In the frozen category, Brian and I were getting a little nostalgic because we know how many times we'd go home from school, or even now perhaps too.
Yep.
And we just want to heat something up very quickly. And typically during a consumer spending downturn, or where dollars become a little bit more discretionary, even in the food aisles, consumers lean into frozen. Where have you seen that ring true once again? Where has that benefited some of the brands specifically for?
Absolutely. Well, we were actually just chatting about this before the launch of Frozen Deluxe. So that's something you'll see from us. We've also launched
What's
Home
Frozen
Bake.
Deluxe?
Oh, Frozen Deluxe is deluxe mac and cheese.
Deluxe mac and cheese. Okay.
Deluxe mac and cheese. Yes. Get out and try that. I think the other one that you may have heard us talk about before is called Home Bake. Home Bake $4.25.30. So what that is multiple different mains, veggies, and sides that you can put in the oven all at the same time at 425 degrees for 30 minutes. So you think about this idea that we talked about of quick with quality. You cannot sacrifice quality for the convenience. And consumers aren't willing to do that anymore, and we're leading in hard into that trend.
This is still, I think, a mixed economic backdrop. We talked to Walmart's chief marketing officer and got the sense that they're starting to price in more rollbacks or price cuts in the second half of this year. Do you have to market more value-based messaging in your TV advertising, in your social media marketing, to connect with consumers that, in many respects, might be living paycheck to paycheck still?
Yeah, I think it's incredibly important to acknowledge the environment that we're in. And I think when it comes to value, there is value that comes in price and accessibility. We are in 97% of households. And with that comes a responsibility for accessibility. But sometimes that comes in the form of price, but other times that comes in the form of value beyond price. You think about Channel Pack and the opportunity that plays for the value with different size packs. You think about how consumers actually look at value, and they're willing to pay more for brands that are better quality. So I think the way we look at it holistically is, yes, value is incredibly important, and we know the times that are happening right now, but there's a number of things within our mix in terms of looking at both value, but value beyond price.
We've discussed a lot at Cannes this year about cultural relevance and how that drives even product marketing, engagement with consumers. How does Kraft approach that?
Yeah, I think similar to a lot of our peers, that we look at it as really understanding what's happening in the market through social listening. We have our in-house agency that we call The Kitchen. And really, that's living and breathing with consumers at the speed of culture. But it's also, how do we drive culture? So I think one of the things that you'll see coming out from Kraft Heinz is, how do we be part of conversations that are already happening, but also how do we play a part in actually driving some of those cultural trends from now into the future. But The Kitchen, the agency, plays a phenomenal role. We have 9 production studios around the globe that we've stood up over the last couple of years to be at the speed of culture, but have that as part of our in-house capability.
As someone working inside the company, Diana, I get the sense that investors don't appreciate the turnaround that is happening at your company. Where are you at, inning-wise, in terms of this turnaround? And what should investors know about Kraft Heinz today compared to 4 years ago?
I think the biggest thing is everything starts with ambition, and we've changed our ambition. Our ambition is to lead the future of food. I think the other piece that has changed significantly is the belief. And the only thing we can do is continue to go on the track that we've been on, and people will follow. It's consistency and consistent results. But that's not going to change, that we're going to continue to throw fuel on the fire, whether it's through marketing, through creativity, through innovation, all the way through the line.
Diana Frost, Kraft Heinz, Chief Growth Officer of North America. Good to see you. Thanks for stopping by Yahoo Finance.
Thanks, guys.
Back to you guys.
All right, that was our Brad Smith and Brian Sozzi in Cannes with another great interview. Meanwhile, traders betting against U.S. equities are piling up, with U.S. short interest exceeding $1 trillion this month, according to S3 Partners. Let's get right over to Yahoo Finance's Jared Blickery for more insight from the floor of the New York Stock Exchange. Professor Jared, take it away.
That's right. Guess what? The latest rally, in part a short squeeze. So maybe not breaking news, but the volume, the amount, as estimated by S3 Partners, as you were just saying, Diane, quite jaw-dropping, $1 trillion. I'm looking at the Wi-Fi Interactive at a 2-year chart of the S&P 500. The last time we saw short interest this high was in April of 2022, and that was after this mini blistering rally off of the highs. That was long before we knew that we were going to be entrenched in a bear market, at least most of us, and before the Fed really amped up its Fed rate hiking campaign. Also, when you take a look at some of the most shorted names, not surprisingly, those are some of the biggest gainers and some of the biggest stocks in the universe. I'm going to switch over to the Nasdaq 100 here, where we can see really the mega cap names that have been in focus. First, I'm going to pull up Microsoft, and let me get to a 2-year chart. I'm going to put some candlesticks on it. You can see we just barely exceeded the highs that we had, the record highs in late 2022. This would be a natural spot for the rally in Microsoft to pause, which it has. We don't know if it reverses at this point. If it does reverse, then technical analysts will be looking for the potential for a double top, but nothing like that just yet. And the first step would be to break this really steep trend line. Nothing like that happening yet either. Also want to point out Apple, which has been giving markets a little bit of a head fake. Recently, when it dipped below its 2022 lows at the beginning of this year, that was a head fake to the downside, but in fact, that was quickly reversed. We now find ourselves at record highs, having exceeded those highs in late 2022. So a tiny bit different story than Microsoft. We actually exceeded those highs, but still have not broken that steep uptrend channel. Now, also want to get to Tesla, because this is probably the poster child for most shorted stocks. We're talking about $1 trillion in interest there, about 36 billion in open interest in short positions in Tesla, $14 billion worth of unrealized losses this year. But I'm going to draw a trend line, a negative trend line down here. Tesla managed to squeeze above it. Nice squeeze there. You can see not as close to its record highs as Microsoft or Apple, but nevertheless, when you get a short squeeze in Tesla, it can drag a lot of other things with it. Guys.
Thanks, Jared. Appreciate it. Coming up, we're going to get a pulse check on the state of the housing space with some breaking news on that market. That's next. Welcome back. We got some breaking news on existing home sales, which during the month of May rose by 0.2% to an annual pace of 4.3 million. That is an unexpected increase. Economists were looking for a decrease of 0.7%. So existing home sales staying relatively steady, even given that we have these elevated interest rates. But of course, we do have a pretty tight supply environment that we have talked about quite a bit. So perhaps that helping fuel things here. I'm just looking to update as usual. When we've got breaking economic data, it takes a little while for
the numbers to fully release. I mean, but you compare it to like the month prior. I mean, you can see why analysts were expecting a little bit of a deceleration when you look back at April when it was down more than 3%. So seeing some improvement there. We know that inventory has been an issue in previous months. So certainly, continuing to watch the improvement when it comes to the housing market. And that, and we're still continuing to be in the spring, the selling season. So it shows that strength is holding up. And it shows that the economic strength that we've talked to a number of our guests about is continuing to hold up for households,
Yeah. Just looking at some of the other data that's part of this, the median selling price did fall by 3.1%. That is the biggest year-over-year decline in the median selling price since 2011. So that price is still $396,100, but that's still historically a pretty elevated price, right? And again, is a sign of this tight supply that we are seeing in the markets. Number of homes for sale down 6.1% from a year earlier to 1.08 million homes, which is the lowest level for May specifically in data that goes all the way back to 1999. So again, this really tight supply environment definitely having an upward pushing effect on prices, even though we did see a decline year over year, but still a support under prices, if nothing else.
Indeed. I mean, I'd love to see those kind of prices in our neck of the woods, though. You don't see that here.
All of this is highly, highly regional when we look at these particular issues, but nonetheless,
it shows the strength of the inventory that, as we've talked about, or the strength of the issues in inventory in terms of how price is holding up. All right.
Yes, definitely.
All right, we're going to bookmark that.
Yes.
Coming up, Fed Chair Jerome Powell's testimony before the Senate is underway. We'll bring you some of those headlines. That's next.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Diane King Hall. We are about 35 minutes into the trading day. So let's take a look at some of the top movers here. Shares of Darden Restaurants are under pressure this morning as earnings out before the bell saw profit beat street estimates, but the company's forecast for the year ahead gave room for a miss, and in particular, its fine dining unit, which includes the likes of Capital Grille, Seasons 52, that showed an unexpected decline in comparable store sales. So that's something also weighing on the shares. Olive Garden comps slightly missed analyst estimates.
Meantime, car insurance startup Root seeing shares rise this morning, jumping 36%. This on a Wall Street Journal report on an acquisition offer from Embedded Insurance. Now, Root first went public back in 2020 with a more than $6 billion market cap. Consistent quarterly net losses since sending the company slumping. Not so today. The reported acquisition offer would see Root absorb for $19.34 a share, a significant premium to their current trading price.
Yeah, 35% right now. And AMC seeing shares slide this morning after an official recommended improving the movie theater operators' conversion plan. This is something that had been an overhang, right? You have those so-called ape shares, right, that are a proxy for AMC and maybe eventually will be converted to stock. That's something now that we have seen a court hearing and a court official approve or recommend that conversion. So it's not necessarily that AMC is falling and that APE is rising. It's that the two prices are converging. That's the thing to watch here. And why that's happening is that one may be soon converted into the other. Federal Reserve Chair Jay Powell's second day of testimony is underway, and our Jennifer Schonberger joins us now with more. Obviously, he spoke yesterday and moved the market. That was the House Financial Services Committee. I'm curious if we'll get any different flavor today.
Hey there, Julia. That's right. Fed Chair Powell back on Capitol Hill for day 2 of testimony, this time before the Senate Banking Committee, where he is expected to again be peppered with questions about potential higher capital requirements in the wake of Silicon Valley Bank's failure, as well as interest rates. Powell is still calling for 2 more rate hikes this year, though he says the speed is less important than the ultimate level on interest rates. And while Powell's calling for further rate hikes, Atlanta Fed President Raphael Bostic told me in an interview yesterday he thinks the Fed should be done raising rates.
My baseline is that we should stay at this level for the rest of the year. Look, I actually think that we are still at the very early stages of our monetary policy tightening, starting to influence the economy in a significant way. And I just feel like we have a little bit of time to just let that play out and see exactly how much the economy is responding to our policy.
Bostic says it could take anywhere from 6 to 24 months for the economy to feel the brunt of the Fed's policies and expects the full effects will take hold over the next several months. Bostic is one of the most dovish members of the Fed. The majority of other Fed officials see anywhere from 1 to 3 more rate hikes this year, with most clustered around 2 more rate hikes. The Fed policy rate currently stands in the range of 5 to 5.25%. Bostic wants to do everything possible, he tells me, to avoid a severe recession while still trying to bring inflation down, though he is mindful that the Fed has typically gone too far in the past. And there you see that hearing with Jay Powell getting underway right now. Ladies.
Right. We will certainly be paying attention to that hearing today. Thank you so much, Jennifer Schonberger. Meanwhile, Fed officials are spread on the outlook for rate hikes this year, but the goal is clear: return inflation to a target of 2%. Inflation saw a meteoric rise in 2021 and 2022 and has stayed stubbornly elevated. Mickey Levy, Berenberg Capital Markets chief economist for Americas and Asia, blames the Fed's initial, what he calls erroneous inflation projections, and calling their policy response misguided. Those factors have contributed to what he calls the, quote, biggest monetary policy error since the 70s. Mickey Levy joins us now. So first of all, thank you for joining us. And second, why do you say it's their biggest error since the 70s?
Well, clearly, when inflation accelerated dramatically and the Fed basically said it was transitory due to supply shocks, grossly understated the significant impact of the biggest deficit spending and monetary ease since the 1970s. And so now the buying the Fed is in, it's paying the price for its dithering in 2021. But let me put a positive spin on things. The Fed has raised rates aggressively, and it now has the federal funds rate modestly above inflation, which is good, and it should start slowing the economy somewhat. So the Fed is in much better shape. We should expect inflation to drift down. The critical issue is inflation, as you note, has been sticky, and it's going to come down, but it's not going to come down to the Fed's 2% target. And then the question is, what does the Fed do as inflation recedes modestly but stays stubbornly high?
So, Mickey, if they made that mistake and now they've sort of mostly caught up to it, what's the biggest risk now? And I'm curious if the risks are more weighted to them going too far or not far enough.
That's a great question. I think the risks are fairly evenly balanced. The economy, as you've noted, has been quite resilient, not just in housing, but consumer spending. And let's emphasize that so far, at least, businesses have responded to slower product demand, not by massive layoffs, but by just slowing rehiring. So things are in very, very good shape on the real side of the economy. Certainly, it's a risk if they hike aggressively further. However, on the other hand, if inflation remains sticky high, then that sets a new base, and should the economy strengthen from here, like not right away, but over the next year, you could get an accelerating inflation from a higher base, and that is a definite risk to the Fed. So these risks now are two-sided, and it's a very thorny issue, and the Fed's put itself in this bind.
And Mickey, so you said if they hike aggressively further, what would you characterize as aggressively further? Is that 50 basis points, or is that more than that?
Oh, so that's also a great question. 25, 50 basis points isn't going to matter that much. I'll toss out another risk. What really affects the economy, and with a lag, is not the nominal rate, but real rates. So that if the Fed hikes one or two times more, but keeps rates high as inflation comes down, then the Fed becomes inadvertently tight by real rates, that is inflation-adjusted rates, rising and squeezing on credit and aggregate demand.
Well, that suggests that even if they stopped right now, they would keep tightening for that reason, right?
That's right. Once again, the Fed, all through 2021 and early 2022, as inflation soared, they kept the funds rate at zero, which became an increasingly deeply negative real funds rate. That is, they were easing further. And so, by the way, all of the dovish Fed members now who are saying, oh, you have to watch out for the lags. Why weren't they talking about the lags in 2021 when the real funds rate was becoming -5%, -6%, -7%? I mean, it's amusing if it weren't so serious.
So, Mickey, based on your criticism of the Fed, what needs to change or do differently to avoid where we are now?
So basically, what the Fed needs to do is abide by some simple rules, not mechanically, but be aware of what a Taylor type rule would suggest for where the funds rate should be. Had they followed that general guideline, they wouldn't be in the bind there and now. They would have raised rates earlier. The other thing they need to do is their forecasts, and even the Fed would admit this, were just horribly wrong, and they were based on the Fed's big macro model. How could a macro model that has hundreds of PhD economists working on it completely miss that a $5 trillion increase in deficit spending with the Fed accommodating it and buying half of the new government debt how could it forecast that inflation wouldn't rise? And so the Fed needs to reassess its model and its forecasting, rely more on anecdotal evidence provided by the 12 Federal Reserve Bank districts, and then it really needs to just assess its overall strategy and put in place, while maintaining discretion of policymakers, put in place some of these rules or guidelines that the Fed actually published in its semi-annual report that it's presenting to the Congress.
Mickey, I just want to put a bit of a pause on the Fed convo because I want to ask you about the housing data that just came out, which showed that we're seeing a big drop in the number of homes for sale, in part because people don't want to sell them and then have to buy something else at quite a high mortgage rate right now. How big of a curb or problem is the housing market for the overall economy right now?
Well, I'm very bullish on the housing market. It's not a problem for the economy, but it's a challenge for the Fed. Meaning, what's interesting here is typically housing activity falls during a recession. Housing has already had its recession and is bouncing back, as you see in existing home starts. New housing starts, existing sales are up. People don't want to sell their existing homes because they have low mortgage rates, so that's reducing the supply of existing homes on the market, and contractors just can't keep up with building. And one of the challenges facing the economy is not weakness in housing, but that when we get out of this soft patch in the economy, we're going to get right back into the supply shortages across the board, not just in existing homes, but in new homes. Now, this is a challenge for the Fed because they know they have to slow aggregate demand in the economy sufficiently to take away some business pricing power to put downward pressure on inflation. So the housing in general is very positive for the economy, and it's a challenge for the Fed on the inflation front.
And I guess a challenge for individuals who are looking to buy houses as well. Mickey, good to see you. Thanks a lot. Mickey Levy is Berenberg Capital Markets Chief Economist for Americas and Asia. Thanks.
Thank you.
Coming up, a tale of two charging systems. What Tesla's partnership with major automakers means for the future of America's EV landscape. Let's talk about the road ahead for the EV charging market. Americans are making the switch to electric vehicles and moving away from gas-powered cars. But the country's map of public highway chargers has a lot of gaps to fill, and those blank spots are being seen as a hurdle to wider EV adoption. Take a look at Tesla's supercharging stations. They're seen as the most reliable in the electric vehicle industry. The EV maker began building its private supercharger network back in 2012, and now Tesla has new deals with Ford, GM, and Rivian to join it. Its charging stations do tend to be larger than others. Its supercharger network makes up 30,000 chargers, with about 18,000 of those being fast, so-called level 3 chargers. But most EV chargers in operation use a separate charging system. It's called the Combined Charging System. It's known as CCS, and the U.S. government has put billions of dollars on the table to build out this network. So as more drivers migrate to Tesla superchargers, it could push the industry away from one universal charging standard. The EV market, though, does remain resilient in terms of the number of new electric vehicles sold last year, reached over 10 million cars across the globe. EV sales also reached a global market share of 10% last year, which was driven mainly by growth in China and Europe. Meanwhile, passenger EV sales in the U.S. soared over 79% in the first quarter of 2023. In addition, EV sales continue to surge in new segments of road transport, setting the stage for some big changes in the EV market. Sales for 2- and 3-wheelers gained momentum last year as the industry continues to tap into battery improvements and enhance its charging infrastructure. So obviously, the demand for electric vehicles is here to stay. Let's bring in Carl Brower. He's iSeeCars.com executive analyst, and Jennifer Hiller, the Wall Street Journal energy reporter. Thank you both for being here. Guys, let's start with chargers. How did this happen is my first question. Like, I have a gas-powered car. The nozzle for every gas station in the country is going to go into my car, and it's not a problem. So maybe, Carl, I'll start with you. If you know this, like, why are there different charging standards in the first place?
It's a common issue when you have technology developing, especially rapidly, is that there's no way to standardize it. You have a bunch of individual players doing their own thing, and there wasn't any cohesive effort in the electric car world. And Tesla, which became, the dominant force in the electric car world so far, they had their own plug, and then everyone else had a different plug, and nobody standardized them. And now they're talking about maybe we should, and hopefully we will soon.
So, Jennifer, let's talk about your coverage. Of course, we know that the government is making a big investment in EV and EV adoption, setting aside $1 trillion in terms of the infrastructure bill, expecting to grow EV chargers by building 500,000 more by 2030. From your coverage, is that fast enough for what we're seeing in terms of adoption?
Well, the cars are coming quickly, and the concern is that the chargers won't be there to meet them. But there are a lot of new chargers going into the ground, and I think it just remains to be seen how quickly this infrastructure can get built over the next several years. The Biden administration, as you mentioned, wants about 500,000 public chargers out there. There are McKinsey estimates that they think we need more than 1 million public chargers out there. They're going to be different kind of chargers. Not all of them will be these highway fast chargers, which has been, sort of the focus of the recent Tesla, Ford, GM, Rivian news. A lot of them are at a slower level, similar to something that you might have in your garage at home or in an office parking lot or something like that.
Well, and to your point, most people charge their EVs at home, right? That's their primary thing. They plug it in at night, just like I plug my phone in at night so I can use it for the next day. So for people who are driving electric vehicles, Carl, what role do these charging stations even have? Is it only to allow people to drive longer distances?
Yeah, it's a great question. I think that you have people who need the daily use that they do with these vehicles, and it's not that demanding, and the home charging works great for them. But there still is this issue of range anxiety. And I always tell people range anxiety isn't the fear of being stranded in the middle of nowhere with no energy. You can find a charger today. There are chargers prevalent enough that you'll likely find one. But when you do, you've got to spend the time it takes. And as Jennifer mentioned, most of the chargers out there are not even level 3. And when you've used a level 3 charger and you charge as rapidly as it does, which still takes 20, 30, 40 minutes, depending on how much charge you need, and then you go use one of these level 2 chargers, which are the overwhelming number of chargers out there in the country, it's, like 1/10 that speed. You have to spend hours. So range anxiety comes from the fact that when you run low of energy in an electric car, unlike a gasoline car, you don't solve the problem in 5 to 10 minutes just by, looking around and finding the gas station. You have to find a charger and you have to dedicate a long amount of time. So the home charging is great, but it still tethers you to your home. And if you go further than what you're comfortable with going away from your home, you've got to deal with somehow figuring out where to charge and how you're going to make the time and energy to do that.
So, Jennifer, to elaborate on what Carl is talking about here, the range anxiety issue, how do I find, so similar to Julie, I have a gas-powered car still. Eventually, I want to get there with EV, but, given this range anxiety issue, I know, for instance, if I want to gas up, I generally know where gas stations are. And I can look on GasBuddy.com or GasBuddy, the app or whatever, to find, and that's more for cost, seeing what's the cheapest price around me. How do I even find where to charge my vehicle?
So there are apps similar to GasBuddy. There are apps like PlugShare that will kind of help guide you to public chargers as you travel and help you do some trip planning, depending on the kind of EV you have and how new it is. The EV will help guide you where you need to go in terms of finding public chargers. So that, that aspect of it is available. It requires a little bit of technology. But to your point, it is, gas is not something that we think about. It's sort of all over the place. It's very rare on a road trip that you're really thinking, oh gosh, I need to fill up in case I can't in a little while. And the idea of having to do sort of complicated road trip planning shows up time and time again as a hurdle in driver surveys about EV adoption. There was just a JD Power survey that came out last week that said, of nearly half of people who will not consider an EV said that their top reason was a lack of public charging.
Jennifer, why are the charging companies still even bothering with those level 2 chargers? Why aren't all of certainly the new chargers at least, level 3?
Well, a lot of people think what we need is actually a lot more of the level 2, a lot more of the slower chargers everywhere, and that's just the predominant way that we are all going to be charging, because our cars are realistically parked a huge number of hours of day. They're either parked often at work, they're parked at your house or apartment, and that we need to bring those just, slower chargers that let you sip electricity all over the place and make those more ubiquitous. And so there is like a little bit of debate within the EV industry and among EV advocates as to like how much resources should go towards these faster chargers and how much should go towards these level 2 slower chargers. Most people would say we need a lot more of everything. It's also a lot cheaper to put in the slower chargers. So that's another issue is, there's a lot of federal money on the table, but it is a limited amount of money. There's a limited amount of capital that can go into building out all of this new infrastructure. And so it's like, where are you going to get the bang for your buck? So there's a bit of a debate about that as well.
And Carl, I got to ask, speaking of that debate and in terms of like wider EV adoption, I think about road trips and that being one of the concerns. So I'm going to use a phrase from a song. I don't know if you know this one. Are we ready for the road? I'm not doing the Caribbean intonation for it, but you know what I'm talking about. Are we?
Yeah, we're not ready for any kind of serious road trips for electric cars. I mean, people have been driving across the country in Teslas, and to his credit, that was one of the focuses for Elon and for Tesla, was to put those superchargers on the main thoroughfares across the country, so you can and people do drive their Teslas across the country, and non-Tesla people will now have access, so that will help the road trip situation. But I think about the fact that one of the big pulls for Tesla vehicles was their own unique, dedicated network, supercharger network, and now that's not going to exist. So I worry about what that's going to do, or I don't worry, but I just wonder about what that's going to do to Tesla's demand, because it does impact negatively his appeal. But it's still down to the fact that we have less than 10%, somewhere between 5 and 7% of cars out there are electric. and you still can be challenged to get them charged, whether it's finding one, whether it's been vandalized or isn't working when you get there, and whether there's a line of people in front of you, which happens a lot, for instance, at Tesla superchargers during travel weekends. And so as Jennifer said, we need a lot more chargers of all kinds. And the Tesla charger network opening up to non-Teslas will help. But I think the term drop in a bucket really applies here if we're going to have 2/3 of new cars being electric, which is what the current administration wants in the next 10 years.
All right, we'll have to leave it there. Thank you so much, Carl Brauer, ICCars.com executive analyst, and Jennifer Hiller of the Wall Street Journal energy reporter. Thanks so much to both of you. Coming up, is a crisis looming for commercial real estate? We'll get a pulse check on the space with Walker & Dunlop CEO Willie Walker. That's next. Stay with us. Commercial real estate concerns are on the rise, with national office building vacancies climbing to nearly 13% in April as the shift to a hybrid work environment continues to take over. So how can commercial real estate investors position themselves? We'll dive into that and more. Joining us now, Willie Walker, Walker & Dunlop CEO. Willie, thanks so much for joining us. First, we've seen some of these cracks coming within the commercial real estate space, especially after you saw the issues within the regional banking sector. How would you characterize the state of the commercial real estate market right now?
Challenged. I think challenged is probably the proper way to put it. But I would also say not distressed, in the sense that I think, to your question about regional banks and bank exposure to commercial real estate, banks are about 40% of total capital to commercial real estate in the United States. And that's a total market size about $4.4 trillion. And so banks have a lot of exposure. To your question about office is a challenged asset class. But I think there's been a longstanding view that all of this kind of comes crashing down and there's some big cliff that everything's going to fall off sometime in this near future. And that's just not the case. Every property has a distinct maturity on their loan. Each loan has got a distinct leverage level to it, and how banks decide to work on these deals and either refinance them or not refinance them, it will take time to see. And obviously interest rates have a big impact on that.
I mean, each deal is different, but there are some overall overarching themes that are affecting real estate as a whole. And the fact that rates have gone up to the extent that they have certainly has had an effect on the market. And you guys do financing of some of these deals. I mean, are you really pulling back on what you're seeing in terms of activity that you're willing to do right now?
Yeah, we've seen, lenders are concerned right now. They're concerned about the underlying fundamentals, particularly of office. We're very focused in the multifamily space. We're the largest lender for Fannie Mae and Freddie Mac on apartment buildings in the country. And multifamily has held up very, very well. And so if you think about the various asset classes in commercial real estate, industrial has held up the best. And that's all of the distribution centers that get goods from Amazon to all of our doorsteps. Multifamily is in the second position of holding up quite well. Below that is retail, then hospitality, and then office. And so as you go into those various asset classes, if you're lending on them on an industrial property, you're lending in very similar conditions to how you were lending on them a year ago or 2 years ago. If you're lending on an office building, that's the worst asset class right now. And as a result of it, you're going to have your cost of capital be much higher. You're going to have the loan terms be more restrictive. And there are very few lenders that are looking for office financing or office deals right now. But the real issue there is banks have a lot of exposure to this. And it's in their best interest to work with the borrowers to try and find a solution. This is very different from 2008, 2009 during the great financial crisis, when banks didn't have the liquidity or the timeline to be able to work with borrowers. They would just have loans default, they would foreclose on them, and they would take over the real estate. And so I think there's a big difference between what happened in the great financial crisis and what is happening today in what you would call the great tightening.
Okay, and speaking of kind of the today framework, let's talk specifically about office and the troubles there. And I am surprised to see you saying that retail is holding up, because I've seen some different data points talking about looking at nearly $23 billion of distressed assets tied to retail. I'm going to bookmark that. We'll come back to that later if we have time. But with office, what do you think?
Just on that, just real quick on that, because we can deal with it really quickly. If you look at the publicly traded companies, most of right now at a discount to net asset value, the industrial companies are trading close to par. The multifamily publicly traded REITs are trading at about a 10% discount to net asset value. The retailers are trading at about a 20% discount to NAV. The hospitality is about 30% and office is about 40%. And that's just off of the publicly traded comps of what net asset value is now. So that's just, there is liquidity there. And the only point on retail is what we have seen very much is inline, well-placed strip retail has held up very well as consumers continue to spend money. Big box retail has been more challenged.
Okay, got it. So it's strip retail holding up. And okay, you also pointed out that multifamily holding up well, certainly seeing the strength there in terms of the numbers. What's the solution in terms of office? We've heard a lot of talk about conversions. Do you see that as a possible solution, or what would you say is the solution there?
Conversions will clearly happen. And there are developers who are trying to convert properties. It's a lot harder to do and a lot more expensive to do than many think. And so there are lots of people in local municipalities across the country saying, let's just convert all this to residential and we'll be fine. We need to see people go back to the office, period. We need to see people use office infrastructure, and we need to see companies invest in office to make it a place that people want to go to work. Because if not, there's a big ecosystem around office. It's not just the fact that the landlord might have a building that doesn't have tenants in it. It's the sandwich shop in the corner. It's the Walgreens pharmacy down the street. It's the public transportation that's making money off someone taking the bus. It's a taxi cab driver who gets someone to take a taxi into the office, et cetera, et cetera. The parking lot that doesn't get the parking revenue. All of that's going to drive down tax revenues to local municipalities. That's going to make it so they can't invest in police and fire. And that's going to be a hollowing out of the American city. And so it is up to cities and, quite honestly, all of us to make sure that we don't lose the urban core that has defined the American experience for so long. And while there are great suburban places here in Denver, Colorado, we are moving our headquarters here in Denver from downtown Denver to an area called Cherry Creek. Why? Because Cherry Creek has got restaurants. It's got a vibrant community around it. It's an easier commute for most of our employees. Are we leaving Denver? Not at all. Is Cherry Creek 3 miles from downtown Denver? Yes, it's very close. But at the same time, that is one more move out of downtown Denver, which really needs to be revitalized. And I would say that, in Denver, we have a new mayor who's coming in. Fortunately, the voters of Denver, Colorado voted a mayor who is going to invest in the city and try and get us back on the right track. There are plenty of other cities across the country that have gone in a different tack and are basically saying, we don't need to attract the investment anymore. We're okay. And that's problematic, I think, for the long-term outlook of some of those cities.
Yeah, and it's definitely been very patchy, to your point, in different cities around the country. We're going to leave it there for now. We'll talk to you again soon. Willie Walker, Walker & Dunlop CEO, thank you.
Thank you.
Coming up, we'll head back to Cannes, where Brian Sozzi and Brad Smith will get a pulse check on the consumer with an executive from Procter & Gamble.
I'm Brian Sozzi here with Brad Smith at the Cannes Lions Festival of Creativity. Joining us now is P&G Chief Brand Officer Mark Pritchard. Mark, great to get some time with you here, and we've really been diving into the business behind Cannes Lions. There's a lot of big activity here, a lot of key meetings. From a P&G perspective, who are you meeting with, and why are you here, and what do you hope to achieve?
Well, why we're here is we kind of consider ourselves the hardest working company in the festival, because we are here to learn, get inspired, and figure out how we can continue to grow our brands through creativity. I just did a keynote speech on creativity that grows markets. It's the highest order ambition, because in our categories, which are the cleaning, health, and hygiene products that people use every day, the way that the best growth is market growth. And so that's what creativity should do. It should be inclusive, insightful, and impactful, because that's what's going to make the market better. And it makes consumers' lives better. You attract more people in the market, you delight them with better performing products, and they reward you with buying more and making the market grow.
I think a lot of investors on our platform realize that this is a different P&G, notably over the past, let's say, 3 years, a real innovation burst, cool names on these products that do different things. What is the secret sauce to getting consumers to buy some of these newer products, and how do you stand up the innovation and the storytelling behind the scene?
Secret sauce is focus on the consumers. Focus on what are the consumers' needs, what are their jobs to be done, the problems to be solved, the habits that they need to form, and then identify how you can then create a superior performing product, a noticeably superior performing product in a noticeably superior performing package, and then communicate that in such a way that is insightful and tells them what the product is, how it works, what it does, why it's better, how it's going to delight them, and then reach as close to 100% of people you possibly
Mark,
can.
I've used so much about Power Wash and the Microban. I can't stop using this.
Dawn Power Wash is an amazing product.
It's the sprayer bottle, the bottle. Right. It's great. It just
based on an insight from the consumer, which is that people were washing in one dish at a time. So all right, let's make it easy for them. Spray, wipe, rinse, done.
Sorry, Brad, get in here, because I could go all day talking about some of these products.
I mean, no, they're truly amazing products, and we've seen them really evolve over so many years. And what's also evolved is the environment that you're selling into, the consumer, the culture as well. One of the themes that we've been discussing here this week, and we've heard from some of the chief brand officers like yourself, is cultural relevance. What does that look like at P&G as you do approach the market?
The way we think about it, Brad, is that our job is to make sure that we serve all consumers and each individual consumer based on what their needs are, and do it in an inclusive way, and do it in a way where possible that's sustainable. So, for example, what we do is we try to identify how can we best meet the needs of the black consumers, white consumers, Hispanic consumers, Asian consumers, Native consumers, LGBTQ plus consumers, and both in the U.S. and in different markets around the world. So it's understanding unique insights, and when you understand those unique insights, that allows you to be able to serve them with products that meet their unique needs, and that is what's most relevant, particularly in our products, because our products are everyday household and personal care products that people want to know how they work, and they want to know why they're better for them. That is what creativity that's inclusive is about, and that is very culturally relevant.
I view that your role is incredibly important, because it is the data you get and the messages you tell that drive the financial statements. It drives the earnings calls and the earnings releases that a lot of people, a lot of investors on Yahoo Finance ultimately read. What new needs are you seeing emerge in consumers? And what should investors know about what P&G is about to stand up product-wise going into 2024?
Well, look, our strategy is just crystal clear. We focus on superior performing products, packaging, communication, retail execution, and value, fueled by productivity and constantly constructively disrupting. The constructive disruption aspect of it affects us here in creativity, because there's so many new mediums in which we can reach people. From a media standpoint, what investors should know, and they've heard this a couple times, we want to reach mass reach, as close to 100% with precision. We don't want excess frequency. We want to get to as close to 100% as we possibly can, and we're doing that on some brands. We're close to more than 90% reach on Tide. We're close to 95% reach on Pampers, but that is a very narrow audience, because it's just diapering households, and we do that through data. We do that through programmatic spending, where we're able to precisely reach people. We then are also using AI to figure out how we can optimize the creative execution. So Pampers has 140 different pieces of creative optimized through this program called AI Studios, which allows us to be able to test ads versus a big database of reactions and figure out how we can make it better. That's a way in which what we're doing is we're giving precision and we're increasing effectiveness and reaching as many people as possible, which gives us a runway for growth and market growth, of course.
Just briefly, how far are we from AI telling me whether or not I'm using the wrong shampoo, or the wrong lotion, or the wrong, detergent?
We're staying in the same hotel, Brad. You use a great shampoo. I just want to let the universe know.
Yeah, what AI, first of all, I think, there's a lot of discussion about AI here, and what are lots of applications already being used for AI. The one that I just mentioned is to figure out how you can get better creative and improve the productivity. What AI could do is at some point, we'll be able to tell you those kinds of things because it'll understand, and there's a way in which you can do dynamic content creation that allows you to be able to then reach you based more on what your needs are. So lots of practical applications. The way we're looking at it is in terms of what are the practical applications to make our media better and more precise and be able to reach the people we want and make our advertising more effective so we can have greater impact and drive more growth.
All right, we'll leave it there. I know you're a busy guy. Please tell John Moeller, your CEO, that we'll talk to him in a few weeks for earnings. So we always look forward to talking to him. Mark Pritchard, good to see you. Brian Sozzi, heading it back over to you.
All right, once again, our thanks to Brian and Brad over in Cannes for us. Meantime, it's not just Squid Game that will be seeing a comeback to Netflix. Netflix co-CEO Ted Sarandos said that the streaming platform will be investing in Korean content, including new original series and sequels to some of your favorites. Now, this comes after the company made a public commitment back in April to spend $2.5 billion on original content. Our very own Ali Canal has more. Ali?
Yes. So this commitment that Ted Sarandos made back in April, $2.5 billion in Korean original content over the next 4 years. That's something that the company wants to continue to invest in, continue to grow. Sarandos making it clear that he wants to expand beyond some of the originals that Netflix has done. So that's been more so dramas. So they've been referring to that as K-dramas. Now he wants to go into unscripted. He wants to go into Korean movies because we've really seen this surge in popularity for originals like The Glory and All of Us Are Dead. In addition to just creating content, the company also wants to continue to nurture some of that talent in the region. So the next generation of emerging directors and screenwriters. So really feeding into this narrative from Netflix and from Netflix analysts that international exposure, international content creation is something the company is looking for. And it doesn't necessarily have to be the next big Squid Game that comes over to the US and explodes, but really creating that localized content that can do well in those local regions and see a type of success that we haven't seen. And that's really what's separating Netflix from a lot of these competitors out there in the streaming war. It's such a competitive market right now, but this is an area of a lot of untapped potential.
Yeah, and they have a big international exposure. Just real quickly, this also helps them avoid the writer's strike, doesn't it?
I was just thinking that.
Yes, 100%. Now, there has been some issues overseas with these local content creators saying that Netflix hasn't proportionally shared in the success of some of these shows. So perhaps what's happening here in the US could eventually happen abroad, but definitely helps them with the writer's strike because no one's striking over there. Then you're creating more content, especially if they go the unscripted route. That's something that can be turned pretty quickly. So we'll see how this feeds into it because the writer's strike, there's no end in sight at this point.
Yeah. All right, Ali, thank you so much. Appreciate it. Well, we want to keep you up to date with day 2 of congressional testimony from Fed Chair Jay Powell. He's been grilled for almost an hour now by the Senate Banking Committee. You see a live shot of him there. On progress with the path of inflation, Powell pointed to lower energy prices helping bring down the headline number, though he quickly switched his focus to the core figure and what he sees as a lack of progress in tackling service sector price rises. He also commented on the so-called lag effect of the multiple rate hikes, saying policy works quickly on housing, but it's a different issue for services. As to the banking sector specifically, the Fed chair has been grilled on exposure to real estate, one senator referring to it as a ticking time bomb. Powell acknowledged risks related to commercial real estate, saying the Fed is working with banks to address the problem. Referring to the fallout from the banking crisis earlier this year, Senator John Kennedy asked Powell if we'd gone from too big to bail to we're damn happy they're big. Trying to do my best Kennedy accent there, though the time elapsed before Powell could answer. So was he even really looking for him to answer? And that's probably the case with a lot of this grilling, right? It's a chance for these senators to grandstand.
And air their grievances, if you will.
Exactly. We've got the Nasdaq in the green now, and it looks like the other major averages are climbing in that direction. Rochelle Akufo's got you for the next hour of the trading. She's going to keep you posted on all of that.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Fed Chair Jay Powell speaks again a day after rocking markets as the pause unfolds. We also have Atlanta Fed President Raphael Bostic's take on why his baseline is to hold rates through 2024. Other global central banks are fully in tightening mode, though. The Bank of England and Norges Bank hiking interest rates by 0.5%. We talk rates and stocks coming up next. And don't call it a comeback. Bitcoin briefly breaches $30,000 as big institutional players like BlackRock and Fidelity break into the space. It hasn't hit that key level since April, and it could be tested today on Jay Powell's remarks. We're across the breakout for you. And another day, another downgrade. Tesla stock trying to claw back some gains, but Morgan Stanley's Adam Jonas downgrades the EV leader to a hold from buy. But he says Tesla is still a must-own EV stock. But is it? We'll discuss coming up this hour. But first, let's check in on how the major indices are faring an hour and a half into the trading day. Looking at a mixed picture here, the Dow here under pressure, about 70 points, about 0.2% there. S&P 500, they're also down, but ever so slightly, down about almost 4 points there. We're seeing real estate the biggest laggard sector-wise. Tech-heavy Nasdaq, they're the only one in the green. They're up 0.25% or 33 points. Let's also check in on the Treasury market that always tends to move anytime we hear from the Fed. We see the shortest term 5-year yield here up about 1.6% on the day. The 10-year also up about 1.6%. And the longer term 30-year yields, that's just up about 1.3%. Well, as our next guest says, it hasn't been an easy year for bond investors. The Fed's continued tightening, an unstable banking sector, and a long debt ceiling fight have contributed to volatility in the bond market. So what should the next move be for investors, especially as the probability for more rate hikes grows? Joining us now is Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Good to have you on this show here. So as you mentioned here in your notes, it hasn't been an easy year for bonds, but what have been the best performers in the fixed income space?
Well, it's actually been the high yield market, which is a little surprising because when you have an inverted yield curve and a Fed determined to slow the economy, typically you wouldn't think about going into the lowest credit quality bonds. But they've actually done well because the starting yields are so high, and we really haven't seen the market price in yet sort of recessionary conditions that would typically make the riskier bonds, the lower credit quality bonds, underperform. But in general, across the board, almost every index that we track in the fixed income market is positive on a total return basis year to date. And that's really because we're starting with so much higher yields than we've seen in a decade or more. That's really helping to stabilize the market and produce those positive returns from the income component.
So here we are halfway through the year then. What's really stood out to you so far?
Well, I think the dominant trend has been the inversion of the yield curve. So on the one hand, you have the Fed hiking rates dragging up short-term rates, while intermediate and long-term rates have just kind of trended sideways to lower. So we've just got this morning, the 2-year, 10-year Treasury spread actually went down to negative 100 again, kind of testing the deepest level we've seen in a very long time, since the 80s. And I think it speaks volumes about what the market is interpreting from the Fed. I think the market is saying, okay, we know the Fed's going to tighten, but we believe they're going to bring inflation down and slow growth. So we're going to invert that yield curve, and longer term rates are going to drift lower. And that's probably the biggest thing, the biggest trend in the market this year.
And what do you think is going to be the biggest risk for bonds, especially in the second half of the year? You have the Fed in this hold status at the moment.
Yeah, the Fed's told us their plan was to hike and then hold and then kind of recalibrate down the road once inflation heads back towards a 2% target. And we seem to be in this transition period between the hiking and the holding period, where you get disagreement among the various Fed members as to whether we've seen the peak or not. But I think the biggest risk would be if inflation doesn't continue to trend down. It's been a lot of focus on the sticky part of inflation in the service sector. I think Fed Chair Powell mentioned it today in his congressional testimony. We're expecting that to come down as the numbers sort of work through in the second half of the year. But if for some reason that doesn't happen, to me, that would probably be the biggest risk in the bond market.
And it is tempting to really sort of hold tight to these short-term investments when you have this sort of volatility. Is this the best move, though?
No, we don't think so. So we've been suggesting investors extend duration. And there's a couple of reasons for that. I mean, it is tempting to sit at 5.5% in a short-term T-bill and just ride it out when you get less, say, in a Treasury yield with a 3 or 5 or 10-year maturity. But you do have some significant reinvestment risk if yields do come down as the market expects as a result of Fed tightening. You'll be rolling over those short-term investments into lower and lower yields. So we think it makes sense to take some duration risk. And frankly, you're locking in some pretty decent yields now, yields we haven't seen for a long time. If we look at not just treasuries, but investment grade corporate bonds or investment grade municipal bonds. I mean, we can build a portfolio now that has very attractive levels of income for income investors that can go out, 5, 7, 10 years. And we think that it makes sense to take that opportunity. So sitting in cash, I know is tempting, but I think in the long run, you do a better job of mitigating your risks down the road by having like a bond ladder or at least extending duration to an intermediate term, 5 to 7 year time frame, so that you have some of that locked away for the future.
And as we look at some of these projections for recession potentially, I know that's getting sort of pushed out to, I think, at 2024 by most economists at this point. But should we still be bracing for more of the same sort of volatility for the second half of the year?
Well, I sure hope not. Volatility in the first half of the year was really remarkably high. Now, some of that had to do with the banking sector problems that hit in March. It's come down a bit since then. And some of it had to do with just the rapid rate of Fed rate hikes. Coming into the year, even the Fed wasn't predicting they were going to go 500 basis points or more in this cycle. So I think we've got those two big contributors to volatility behind us. The banking sector still presents a risk. I think the communications from the Fed is even if we get a rate hike or two, that shouldn't boost volatility. Now, volatility in the bond market just reflects uncertainty about the direction of interest rates. And I think we have a lot more clarity on that now. We still don't know where the peak is, but it's unlikely to be as rapid a rate increase as we've seen, or surprising number of rate increases that we've seen year to date. So volatility should stabilize, I think, barring some big fallout in the banks, maybe as a result of commercial real estate problems or something like that.
So certainly some risks ahead, but perhaps not as much volatility as we've had already this year. Fingers crossed, at least. A big thank you there to Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Thank you for your time this morning.
Thank you.
Well, you're very welcome. Well, Powell's crypto commentary in front of the House on Wednesday sent Bitcoin surging, now hovering around $30,000. But is the cryptocurrency being overbought? We have Yahoo Finance reporter Jared Blickery with the breakdown for us. Hey, Jared.
Hey there, Rochelle. Just look at the green here. This is only over the last 24 hours, but Bitcoin, Ethereum, each up for more than 1%. This comes after an interesting day, not only with Powell in front of Congress, but also some of those Bitcoin ETF service providers. They have filed for a new Bitcoin Cash ETF. That is a spot ETF, or excuse me, Bitcoin spot that trades what it does in the cash market as opposed to the futures. And this has important implications because we know Gary Gensler has been coming down pretty hard this year on a lot of entrants into the crypto space. All of these lines here on this chart represent a filing or an expected filing against a member of the Bitcoin community. Here we have the SEC suing Binance and its CEO. We also have Coinbase as well here, and that was at the recent lows. But what I really want to point out is that we are in a technical pattern right here. We have an uptrend overall. You can call this a bull flag, and I think the market was just looking for a catalyst to break out, and it did to the upside here. That is what it tends to do, continuation of the overall trend. But one thing I have been noticing is the correlation with tech, and especially the mega cap stocks, has not been holding true over the last few days. Sometimes markets decouple, sometimes they come back together. But you take a look over the last 4 days, this blue line, the cyan line down here, that is the Nasdaq 100, which is slightly down, actually down about 1.5%. And then we have the ProShares Bitcoin ETF, BITO, that is up about 18%. So quite a big divergence there. And the divergence didn't start today. In fact, we've been seeing this for some time, a decoupling between what was, I would say, last year, a close correlation between the stock market and crypto, and now a little bit different. Here's a year to date, and the steady cyan line right here, this is the QQQ that we were just looking at. And then we have BITO, that's the Bitcoin proxy I'm looking at here. Here's that bull flag. Even though it is a bull flag, you'll notice the trend is down over this very short period of time. But then we finally got resolution popping back up to the upside here. And just to give you an idea of how much more volatile crypto is than the ordinary market, we can see a lot of these swings in here tend to be a lot bigger when we consider what's happening in the crypto space. So overall, I'm just going to go back to our heat map here. I'm going to show you what's happened over the last 4 days. Really positive technical action. But to answer the original question, is Bitcoin overbought right now? Could be a little bit overbought. Here's that year-to-date chart. I was looking at one measure of being overbought, which is RSI. It's a scale of 0 to 100. It's not even past that 70 period. And so anybody looking at a chart might say, well, it has a little bit to go. Based on the technicals here, you'll see that it almost matched this high, or actually did exceed this high right here. And that would probably be cause for a pause, maybe a little bit more. Hard to say.
Indeed. I know a lot of crypto enthusiasts have been waiting for that breakout moment. We'll see if this can hold. A big thank you there, as always, our very own Jared Blickery there. Right, let's take a look at shares of Accenture. They're falling today after the company's third quarter results showed disappointing new bookings and its revenue forecast misses Wall Street expectations, down there about 2.8% right now. The company added to concerns around dwindling IT spending, CEO Julie Sweet saying clients held back on small deals amid economic uncertainty. Straying away from this year's AI hype, the company says it doesn't expect generative AI to be a big growth driver in 2024, as it focuses more on migration to cloud. But not to be completely left out, Accenture announced last week that it will invest $3 billion over 3 years in its AI capabilities. Right, well, coming up, AI is, of course, all anyone is talking about, but the hype may hide some hidden dangers. Why AI snake oil is ultimately a distraction. Next. The AI hype is real, specifically the chatter behind generative AI. It's all people are talking about these days. But is this advanced technology distracting us from important discussions surrounding the safety of AI tools? Yahoo Finance tech editor Dan Howley joins us with the details. Hey, Dan.
That's right, Rochelle. A number of experts that I spoke to discussed the idea of this kind of AI snake oil. And look, if anybody has talked to you in the past, I guess, few months, whether you're at the grocery store checkout line or you're hanging out at a friend's barbecues, they've probably brought up AI at some point. And so a lot of marketers recognize this. Folks on Wall Street recognize this. And, I can say for myself, my inbox is flooded with everything about AI, whether it's real, imagined. I mean, it's there. I'm getting tons of it. And so a number of experts that I spoke to had said, look, there's this kind of prevalence of kind of AI snake oil, where it's products that promise the benefits of AI, but don't really use AI or don't explain how AI is actually helping the products themselves and ultimately the users. And so the reason why this is a problem is not just because it kind of takes away from the reality of what generative AI specifically has to offer, and AI in general, but it also tends to gloss over the various problems that come along with something like generative AI. That includes the risk of misinformation, disinformation, inherent bias that comes with these types of algorithms, because let's face it, there's no unbiased algorithm. It's developed by individuals with their own biases. And so these are some of the issues that really could be glossed over as a result of this kind of overhyping of AI. And so, experts that I spoke to said what people should be doing is looking at, not necessarily the Terminator doomsday scenario that's been floated around, but the near-term threats, those issues like disinformation, misinformation, copyright issues when it comes to artists whose works are used to train these kinds of models, especially when it comes to images. These are the issues that a lot of folks are saying need to be discussed and looked at seriously, and not just kind of thrown away to the winds because people are excited over a technology that admittedly is incredible, but ultimately is something that people will end up using on a daily basis.
It's true. Anytime there's a new technology, you do tend to have some bad actors in there sort of, getting their bids in as well. Now, Dan, on another note, before you go, I have to ask you about this battle between the tech titans that we're seeing play out on social media. I already have secondhand embarrassment just as I was watching the tweets. But Elon Musk and Mark Zuckerberg saying they'll go head to head in a cage fight in Las Vegas. What are the chances, A, that you think this will happen, and B, who do you have your bets on?
Oh, man. I imagine they're probably going to back out of this. I don't think either of them want the world to see their, ruddy faces being rubbed into the floor of an octagon. I do think, look, Mark Zuckerberg has been broing down pretty hard with some UFC folks for whatever reason. He's doing a lot of fitness regimens, and he's doing Brazilian Jiu-Jitsu. Elon Musk, he says he's been in fights before. And he is the one that said, Vegas Octagon. So, he's down for it, I guess. My money would be on Zuckerberg just because he's been doing Brazilian Jiu-Jitsu and seemingly in very good shape. But I don't think it's going to happen. This is literally peak absurdity. I mean, look, if you thought that cartoon pictures of monkeys selling for hundreds of thousands of dollars was stupid in tech, this is beyond that.
But I've got to admit, though, if it did happen, I think everybody would watch it. And I mean, and in terms of the matchup, I mean, Elon Musk is taller. He did say his move would be the walrus. He joked that he would just sort of lay on top of his opponent and do nothing. Mark Zuckerberg has been taking jiu-jitsu, but just last month, he actually got beaten by someone who'd only been training since November. So if this did happen, I don't know. I mean, there's a lot of ego at stake here. I don't think it'll happen either, but if it does, that would be some must-see TV. I would have to watch that.
Oh, yeah, I would tune in, no problem. And not only would I tune in, I would just root for it to be mercifully over quickly because, again, I don't think anybody wants to see these guys get all sweaty and rolling around.
Absolutely not. Well, always great having you on. Dan Howley there for us. All right, well, the Federal Trade Commission renewed its pressure on big tech yesterday, this time setting its target on Amazon. Now, in a federal lawsuit, the FTC alleges that the online retail giant is breaking multiple consumer protection laws by tricking customers into signing up for its Prime subscription service, plus making it difficult to cancel. Yahoo Finance's Alexis Keenan is here with more on that. Hey, Alexis.
Hi, Rochelle. Yes, so the FTC going after another big tech target here. Of course, the FTC has been on the offensive against companies like Google and Microsoft and Activision Blizzard and their tie-up. But this one is about consumer protection laws. It doesn't deal with antitrust issues for a change here. And what the FTC is saying is that Amazon's web interface, as well as its online interface for the retailer, that it is tricking consumers into signing up for Prime memberships and also really frustrating consumers' ability to cancel those memberships. I think we have a screen to show you a little bit about what the FTC is talking about here. They say that when a customer goes to try to cancel their membership, that they have to go through these iterations of steps, 6 steps on mobile in order to get that cancellation to take effect. Now, since Amazon has revised that system, saying they've simplified it for consumers, you can see it there. But once you've pressed there on that screen, there are a lot of other screens and loopholes to go through in order to once and for all get rid of your membership. Now, those memberships are big revenue drivers for Amazon, accounting for $25 billion in annual revenue in 2022 of Amazon's $514 billion in total revenue. The cost for those memberships, $135 a year, or on the other hand, $14.99 a month for consumers who choose to do it that way. But what the FTC is asking for here are some unspecified fines. They want the company to be fined for this behavior. They also want an injunction, the court to step in and say, stop this allegedly offensive behavior. Now, if we look at other companies who have faced similar actions from the FTC on these types of legal grounds, one of those companies is Ericsson's internet phone service, Vonage. That company was settled with the FTC for $100 million. So that might give you an idea of how steep fines can be in this territory. But right now, as of March, Rochelle, the number of Prime members totaled approximately 167 million for Amazon. So definitely this is a big part of their already huge revenue stream.
So, Alexis, how is Amazon responding to this so far?
Yeah, so the company is really, they said that they are concerned, was the word, the way that Amazon put it, that they were not notified of this case before it happened, before it actually hit the court's docket. They said this in a statement to Yahoo Finance: the FTC's claims are false on the facts and the law. The truth is that customers love Prime, and by design, we make it clear and simple for customers to both sign up for or cancel Prime membership. We also found it concerning that the FTC announced this lawsuit without notice to us in the midst of our discussions with the FTC staff. So the company's saying that they were trying to work it out and trying to explain to the FTC how this works, but in the interim, this lawsuit dropped. So we'll see if this goes down the road into a court battle or if a settlement will be at hand.
I know you'll be tracking all of that for us. A big thank you there to our very own Alexis Keenan. Thanks so much. All right, coming up, existing home sale prices fell the most since 2011 last month. Danny Romero will break down those numbers next.
In an exclusive interview with Atlanta Fed President Raphael Bostic, he told me he favors holding rates steady in the current range of 5 to 5.25% through the end of this year, and he doesn't see cutting rates for the bulk of 2024. Bostic is towing the line between not jacking up rates too high to force the economy into recession, while also being mindful of trying to bring inflation back down to the Fed's 2% target. Take a listen to my interview.
My baseline is that we should stay at this level for the rest of the year, but implicit in that is that a lot of things are going to happen in the economy that really signal that the level we're at is sufficiently restrictive to get inflation back to its 2% target. Look, I actually think that we are still at the very early stages of our monetary policy tightening, starting to influence the economy in a significant way. And I just feel like we have a little bit of time to just let that play out and see exactly how much the economy is responding to our policy. I'll just add one other thing on this, which is that when I think about sort of my metrics of urgency, there are really two things that I'm focused on. One is the trajectory of inflation. If it starts to move away from our target and is not doing that today, then that would be a concern. And the second would be long-term inflation expectations. If I start to see that inflation expectations are starting to migrate out away from our target, that has some troubling implications for our policy and for where the economy is likely to go. And it would tell me that we definitely need to act a little more rapidly to get inflation back under control.
The market's pricing in a rate hike in July. Many of your other colleagues see 1 to 2 more rate hikes this year. It's safe to say that you would not vote in favor then of hiking in July.
Well, look, there's still a lot that's going to happen. And, so much of what people's forecasts are, what my colleagues' forecasts are, have implied answers to a lot of things that are uncertain. Are we going to see continued tightening in banking markets as we started to see through the spring? Is our pandemic era policies closing down and winding down not going to have that much of an impact on demand? Like, these are things that are going to resolve themselves in the next several weeks. I'll have a much better sense of what we need to do. But again, I do feel like we're in a position now where some patience can do us well. And look, I really want to try to do all I can to make sure that we avoid significant economic downturn.
To your point, you wrote in that outlook that it's really been the past 150 to 175 basis points of tightening that's catapulted you, the Fed funds rate, into the restrictive territory for really the past 8 to 9 months, as opposed to 15 months that you've been raising rates. So my question is, how much of a lag effect do you think we're seeing this cycle around? Is it slower than in the past? And how much runway before you think the economy really feels the full brunt of your policy?
That's a very good question. The research says that these lags really start to reveal themselves anywhere from 6 to 24 months. That's a pretty big window. By my calculus, we're at 8 to 10 months. So we're just starting to get to the middle of that range. And I would expect that over the next several months through the summer, we're going to start to see that tightening. Now, if we don't see the economy slow down, then I would have to reconsider my position and think hard about whether we need to move forward. But I still think we're kind of still early in the game in terms of seeing our restrictive policies impacts. And I'm very comfortable waiting. But I'm a member of a committee. The committee is not there right now. We'll see what the data bring over the next several weeks.
President Bostic, how do you view credit conditions now? Do you think that the bulk of the credit tightening that we saw from the bank failures this past spring has worked its way through the system? Perhaps we'll see a little bit more on the margin, or do you think there is more significant fallout from that to come?
Well, I think there are really two things to say here. One is that the first bit of trouble happened around liquidity. And I do think that those concerns are a little lighter in my mind right now. The facilities that we've put in place, I think, have gone a long way to making depositors and banks more confident they can manage that. But there is still some credit risk that has yet to reveal itself. I did a lot of work in real estate when I was a professor before I took this role. And when I talked to my contacts throughout that industry, they told me there's a lot of uncertainty about what's going to happen with commercial real estate, offices in particular. And as those troubles start to bubble up, we'll have to keep a very tight eye on what happens in terms of bank lending standards and in how the sector more broadly starts to affect other types of economic activity.
You said you really want to strike a balance here, take a step back and wait. Are you worried that if you were to do more rate hikes, that could tip the economy into recession? The fact that many of your colleagues on the committee see doing at least two more rate hikes this year, does that worry you that if the committee were indeed to raise rates 2 more times this year, that would raise the odds of a recession?
Well, what I would say is this. I've been informed by history. Like my team here, they talk about economic history a lot. And when researchers and scholars look back at Fed actions, there's often been a conclusion that the Fed has always gone like 1 or 2 steps further than they absolutely needed to. And I just have that in my head as something that we should be mindful of as we think about the trajectory of our policy. Look, we have so much uncertainty in the world today. We've been through a pandemic that frankly, I didn't think we would be experiencing a month before it happened. We've had war in Russia and Europe that was inconceivable before, like through my lifetime. So we've just had one unexpected thing after another. And I do think that like just letting the world happen, our policies in a restrictive stance right now, I'm seeing signs that the things are slowing down. We're getting more into balance. Labor markets are easing. Now, all these things tell me that there's really an opportunity for us to have significant slowdown, a significant continued reduction in inflation, and steady movement back to our 2% target.
That was Yahoo Finance's Jennifer Schonberger there, speaking exclusively with Atlanta Fed President Raphael Bostic. Now to housing. Sales of previously owned homes inched higher in May. Home buyers are scooping up the only available inventory in the market. Let's bring in Yahoo Finance's Danny Romero to break down the data. Hey, Danny.
Hi there, Rochelle. Well, competition is back. Buyers are snagging anything that they can get their hands on right now. Sales of previously owned homes edged up in May, but that figure is still 20% lower from a year ago. The lack of homes has been a headwind for the housing market as sellers are really reluctant to list their homes. In the latest report, there's an increase of homes on the market, but that is the lowest count on record, Rochelle. Regionally, the Midwest region remains the cheapest right now. The West Coast saw more buyers return to the market in May. Foreclosures and distressed sales was up in May about 2%, but still a record low. And those homes aren't really much sitting on the market that long. One economist put the housing market in this way. Existing home sales activity is significantly down due to the fact that the current supply is roughly half of what it was in 2019. Rochelle?
And certainly no one wants to move out of their house and take on a higher interest rate right now. And unfortunately, some more pain coming for New York City renters. What can you tell us there?
Rent is going to get a lot more expensive for New York City tenants. New York City's rent board voted to increase rent on 1-year leases about 3% for tenants that are renting at a rent stabilized unit. The board also bumped up rent for 2-year leases. And Mayor Eric Adams said in a statement following the news release that finding the right balance is never easy. But I believe the board has done so this year. Again, that was Mayor Eric Adams' statement, as evidenced by affirmed votes from both tenant and public representatives. But Rochelle, the tables could turn for tenants as economic uncertainty is ahead.
Indeed. Well, thank you for breaking down that data for us. Our very own Danny Romero there. Well, PwC has released its Global Workforce Hopes and Fears survey for 2023, which suggests the Great Resignation might actually continue for a while longer. 1 in 4 employees say they will likely change jobs in the next 12 months. That's up 19% from the last year. More than half of employees say that their job will require new skill sets within the next 5 years. Also, 35% of workers also say their skills are not reflected in their resumes or job histories, with employees believing that companies will be looking for different skills altogether given the rise of technology and new workplace conditions. And of course, the younger generations entering the workforce, they're actually the most optimistic about the use of new technology like AI. 51% say that AI will have a positive impact on their career, and 31% believe that it will increase their productivity at work. Of course, we'll see how this data affects hiring plans in an already tight labor market. All right, coming up, Brian Sozzi and Brad Smith sit down with Mastercard's Chief Marketing and Communications Officer on the sunny shores of Cannes. You won't want to miss it.
Welcome back to Yahoo Finance. You are watching our coverage coming to you from Cannes, France, where we're at the Cannes Lions Festival of Creativity. Brad Smith here with Brian Sozzi, and we've got a great guest here with us right now, Raja Rajamanar, who is the Mastercard Chief Marketing and Communications Officer, as well as the President of Healthcare at the company. Thank you so much for joining us here today.
Thank you very much for having me here. Much
Absolutely.
appreciated.
So you have a lot of customers who may be swiping Mastercard out here, but you've got a lot of business-to-business customers here as well. Take us into the pulse of your conversations and what you're hearing from a conference like Cannes.
See, first and foremost, I think Cannes is predominantly a marketing festival, right? So people are focused on creativity, they're focused on ad technology, marketing technology, the agency models, and how budgets are likely to be squeezed for some of the companies because of the probably expectation of recession or inflation not subsiding enough and so on. And I think the conversation essentially were a reflection of all these. Plus, of course, there is a technology play always with the AI, particularly with generative AI coming in now. There is a lot of hype around it and a lot of discussion and a lot of concerns as well in terms of the ethics and how the whole thing is going to shape industry, the IP issues and so on and so forth on the one hand. And on the other hand, talent is always an issue. And this actually is one of the best places as hunting grounds to find the top talent, and then you try to have conversations with them and see if you can attract them into your own company. So it's been a series of wonderful conversations and excellent meetings throughout.
You're a big spender. You have a big ad budget.
I wish so.
Oh, okay. Well, how do you plan to spend?
Please don't tell my CEO this.
I understand. We understand the financial dynamics. We'll say you have money to spend. Let's put it that way. How are you spending it in later this year compared to 12 months ago? Or do you have that concern given where the economy is?
So, I actually seriously say this, which is that we are a huge brand, but we are not very, lavish in our spending. We are very conservative. We are very thoughtful. We measure ROI of every single thing that we are spending. We connect the dots between the marketing actions and the business outcomes. And so that diligence is really very helpful to us, and therefore we don't sort of have these wild swings which are sentiment based. We have our plans laid out well in advance. We stick to the plans. We can either dial up or down a little bit either way, depending on how the circumstance is, whether it is the competitive pressures sometimes it's economic pressure, or sometimes some new things are happening in the marketplace. So as far as we see, we are continuing to be on an upswing, which is the good news. And, even in a relatively recessionary kind of a situation, consumers are not going to stop spending. On the one hand, the basket changes, the mix of things in the basket change. But for example, if travel is not slowing down. And all of us who came here to Cannes, we saw the ticket prices, whether it is
our bosses saw the ticket prices.
Exactly, right? So you have got those kind of things on the one hand. And on the other hand, you also have culinary, anything to do with eating out. Mm-hmm. That's going through the roof. So there has been a significant uptick in terms of people eating out. Experiences are being sold out like anything. I'm talking more of live entertainment and so on. So there are certain areas which might be paring back a little bit, but there are others which are compensating. So overall, I think, we are not slowing down in terms of our marketing plans, and we are, of course, constantly fine-tuning.
The mix of products and services that people buy into has changed, as you acknowledged a moment ago.
Correct.
But how they spend, that's also changed as well. They're leaning into or tapping less of their cash, perhaps. They're leaning more into Mastercard. They're leaning more into their credit card. Their debit card is perhaps something that they reserve for necessities, whereas their credit card, something that says, let's just have a bridge. What are you seeing in that type of consumer spending action?
So two things. Firstly, the way they are spending has significantly shifted through the pandemic. Right? In pandemic, people were forced to go digital, even if they were not digital before, or people like me who were already doing spending online to make purchases, but only for certain categories. And categories like groceries are never bought before pandemic online. But then when I was forced into that situation, I had to buy groceries. When I started buying groceries, I discovered how easy and comfortable it was, and how safe it was too. So therefore now, even post-pandemic, I continue to do shopping online, even for my groceries.
Are groceries making Mastercard more profitable then?
No, our profitability models don't depend on necessarily which category you're spending on. It's all, there are a whole mix of things. It's not a straight one-to-one correlation. But the point is that digital spending away from cash and checks has accelerated tremendously during the pandemic because of the circumstances. Post-pandemic, when things are coming back to physical, still e-commerce has not slowed down.
One of your largest competitors, let's say they have a blue card. We'll leave it there. They've gained a lot of customers, sub 25-year-olds, whether that's maybe Gen Z or whatever it is. Is there a marketing battle for this customer, and why is this such a lucrative customer base, and how are you marketing to them at your company?
So, firstly, there is intense competition in this category of payments. across all the segments. If you look, for example, the silver segment, as you call people beyond 65 years, they have huge disposable incomes. They have a lot of net savings by and large. And if you think about the spending pattern, these are the bigger spenders than the other demographics. But your future is dependent on the younger demographics. So everyone is competing for those, and that includes Mastercard as well. And what we try to do is, whichever segments you are, we look at 10 passion points in your life. Music is a passion point, sports, entertainment, you have got fashion, you got philanthropy, you got sustainability, shopping, travel. So we got 10 of these passion points, and we try to figure out which segment is responding to what passion point more, and within a given passion point, which sub areas more.
Raja, thank you so much for taking the time
Much
here with us
appreciate
today.
having me here. Thank you. Great talking to you both.
Absolutely.
Appreciate it.
And you've been watching Yahoo Finance and Cam. We've got much more coming up.
All right, thanks, Brian and Brad. All right, coming up, taking a look at some possible health concerns linked to the weight loss drug taking Hollywood by storm. Yahoo Finance's Anjali Kemlani has the details next. Novo Nordisk seeing its shares falling today under some pressure. This comes as a Danish newspaper reported that there's an open investigation into a possible link between the pharmaceutical company's GLP-1 hormone used in treatments like Wegovy and Ozempic and thyroid cancer. Let's bring in Yahoo Finance's Anjali Kemlani to tell us more. Anjali, what do we know so far?
That's right, Rochelle. As you noted, Novo Nordisk is taking a little bit of a hit today over an ongoing investigation into Wegovy and Ozempic, and Ozempic in particular being the drug of focus. This is after a study that came out basically in November of last year, pointing to a potential link. The European regulators, European Medicines Agency, EMA as it's known, is looking into this and has been looking into this safety signal, which it says does not mean that there is an established link between the two. Previously, similar drugs like Ozempic, we know that Novo Nordisk, for example, has had drugs with similar formulas over the past 15 years that have been used for type 2 diabetes, as well as drugs that have been used similarly for weight loss and for obesity for the last 8 years. These have been on the market. These have been used. And so we've seen these sort of signals, especially in the preclinical stage over the last several years, but nothing has ever been, nothing has ever come out in the real world in terms of a link. And that's something that not only the EMA over in Europe, but also the FDA has been looking into. There's an ongoing case study of these similar drugs since 2010. Now, we had a chance to hear back from both the EMA and the company, the regulator over in Europe, saying specifically that they are looking into the, quote, increased risk of thyroid cancers with the use of these medicines, and that it's just an ongoing situation. Meanwhile, Novo Nordisk saying that they are continually monitoring and are aware of the request from the regulator and will be delivering data as needed. So, it's just a matter of ongoing observations. And Novo Nordisk noting in particular the fact that these drugs have been out there on the market, and it will just require ongoing studies of the use of them. Important to point out, Ozempic is the drug that is used for type 2 diabetes in particular, and Wegovy is the one that has been approved for weight loss, specifically for obesity. So two different drug indications, but similar formulas, and so that's where this is all coming from. So it has been known for some time. The European agency did bring it up in their approval process back in January of this year, and they've also listed a bunch of questions for the companies, not just Novo Nordisk, actually. We do know also that this questionnaire essentially to manufacturers has also gone out to companies like AstraZeneca, Sanofi, and Eli Lilly, which we know also has its Mounjaro poised to be approved as well. So a class of drugs, if you will, is what this applies to, and an ongoing study both in Europe and here in the United States on watching the potential of a link here.
We'll certainly be keeping an eye on that. Thank you for getting us up to speed. Our very own Anjali Kemlani. All right, shifting gears now to Morgan Stanley, out with a new note on Tesla this morning. The firm downgraded Tesla to equal weight from overweight and raised the company's price target to $250 from $200. Joining us now is Yahoo Finance's Pras Subramanian to help us break it all down. Hey, Pras.
Yeah, how's it going, Rochelle? Yeah, the old, I like to call it the old cut and raise, downgrade cut here by Adam Jonas, but also raising the price target to 250, like you mentioned. Jonas talking about how this was sort of based on an AI-fueled run-up in the stock, but now that it's kind of now the price is up to over 250, around 250, he sees it as fairly valued at that point. I want to read something from this note. I thought it was pretty funny. He said, "quote I have to be upfront with you all. While the team has defended the Tesla overweight rating all year, I did not see this 111% year-to-date rally coming. We think it's understandable, and we are sympathetic to the changes in the market narrative. But he says that generative AI and the AI that Tesla uses for FSD, which is their full self-driving, are two different things, not the same thing, and investors need to have a wake-up call around this." So I think he's sort of still positive on the stock, but not necessarily positive on the recent run-up, and it says there might be some room to run here, but he says, quote, that Tesla is still a must-own here based on supply chain prowess, maintaining margins, and the fact that there's the ability for other deals beyond charging, like battery tech, software, things like that they can do to sort of increase their value there and get more sort of margin based on their non-automotive endeavors.
So it does seem like he's not that he's not buying into the sort of the Tesla hype, but it's more sort of the AI influence that everything is having and sort of lifting everything and really overinflating it there.
Yeah, and basically
that's
saying
fair enough. That's fair enough.
They got to pump the brakes a little bit on that, but not the overall Tesla story though.
All right. Well, thank you for clarifying. A big appreciation to our very own Pras Subramanian there for us. Right, well, before you go, let's take a check on how markets are faring as we head into the noon hour here. Still looking at a mixed picture. At least we've seen now the S&P has joined the Nasdaq in positive territory. Just the Dow there, the only laggard there, down about 0.1% or 33 points. The S&P, though, now in positive territory, up about 5 points or about 0.1%. Tech-heavy Nasdaq there, up about 82 points or 0.6% on the day so far. Still obviously digesting a lot of that news that we're still getting out of Powell's testimony in his second day today and wondering what's ahead. That does it for now. I'm Rochelle Akufa. I'll be back with you tomorrow morning. See you then.